This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
All right, everybody. Big Meta lawsuit, $16-17 billion settlement. Looks like Meta's putting that behind them. There was rumors, rumblings of that ever since the $5 million-ish payment to one person happened like a month ago. So we'll look at the stock and we'll look at NVIDIA coming into earnings today. This afternoon, PCE data is out. The market is opening in 7 minutes, and we're going to see if it actually matters what PCE does to the market or if it's just a talking point. That and much more. Let's get into it.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is
Also going to check on the talking heads. It's been a little bit touch and go with the buffering here, but this is definitely the story of the day. So let's jump in here while they're talking about it. And right off the bat,
to settle with the FTC
messed up real bad.
on a privacy issue. That was $5 billion. It's had prior settlements.
It's echoing.
Single-digit billions. So this is still
Trying to get this solved for you.
The states weren't just
Should be
also asking for changes.
starting to get this to work here.
So how much of a
right.
relief is it on that front as well?
Yeah, I think I'm still searching for details and reading through this court filing. The accusation from the
Clipping
state
on
is
this
a
big
mix of
microphone, too.
Consumer protections at the state level, and then one federal level privacy
We're getting it.
law. But the basic accusation is that the platforms were designed in a very specific way to keep children hooked on them, and so whether Meta will be required as part of this settlement to change those platforms either algorithmically or from a policy perspective, and it will be for the analysts to kind of work out what any tangible impact of those would be. That is a part of the story here, but I'm still searching for that in this court doc.
Yeah.
Here's the stock, by the way.
Things are quickly changing here. MetaShares.
It's actually going up because it's settled, I guess.
You are looking for that in any
Quote,
details.
unquote.
For what it's worth, again, we just have the $16.7 billion figure in this landmark case with multiple U.S. states, 29 of them suing Meta. Meta agreeing to settle, as Ed was mentioning, the high watermark. They said this could be over $1 trillion. And I appreciate this is still not enough time to completely look through the documents. But if we take a step back, I just wonder where this brings us going forward, because we're talking about major technological disruption and maybe an inability of regulators to keep up with it. Social media addiction, a clear one here with Meta. And now we're going to have to grapple with the changes to society that AI is making. What does this case teach us about ability for regulators, for this court system to keep up with the changes that technology are bringing to society and indeed teens and younger people who use it?
These are the questions. So again, I don't yet have in front of me any part of the settlement that is non-financial. In other words, mandatory product or platform change or technology change. The $16.7 billion deal kind of closes what is one enormous case and potential financial overhang on the stock and the company, but not Meta's broader youth safety legal issues. Part of the item with this case and prior litigation that they've been involved in 2026 is that there are a number of potential, thousands of them, personal injury, school district cases that Meta may or may not confront. And so that has been something that analysts have tried to gauge what comes next.
For that reason, it's
And
good.
just seeing now some of this reporting that Meta has agreed to impose daily limits and nighttime blocks for teenage users, bolster its age assurance systems to prevent children from accessing inappropriate content, and provide extra tools for parents and guardians. Ed, I know this is still a developing story. We'll continue to catch up with you and the reporting from the tech team. Ed, thank you very much. Bloomberg Tech's Ed Ludlow. And we are just moments away from your opening bell. Amanda Gatti is going to be joining us to discuss what she's watching ahead of NVIDIA earnings. You're watching Bloomberg Open
I pull out my
Interest.
broker, huh? It's almost 9:30.
Some see heroes. Others, only egos.
All right.
We see billionaire athletes. A fad to some. The future of money to others.
We can
We
look at
see
these guys
trillion-dollar swing.
too.
The end of jobs.
I just don't know how much it really matters. I mean, with Zoom earnings, the software stocks did get hit. But they're talking about Meta too. So.
Relatively a MailChimp like simulation, and I got it back in maybe 8 seconds. Now there's something I might use.
I wonder at what point
MailChimp
we're going to be able to unleash our own agents to try to figure out ways to reduce our taxable income. Just say, go at it, guys. Figure it out. They probably break into the IRS for all you know. I mean,
well, the IRS will have agents on the other side, working the other side of that trade.
Well,
yes.
Bill Gates.
My agents will talk to your agents.
Yes.
Well, I mean, why isn't that possible?
No, it's all possible. As we'll talk about this more later, but looking into that hugging face.
All right.
And the times
These knuckleheads are going to do the opening bell sometime. It's 9:30.
What those agents did and how they coordinated with each other to do things they were not supposed to do. Amazing.
They have kind of a secret brotherhood.
Yes.
It does seem like that. Now, look, there's no doubt. It's just they're ahead of the humans. I mean, I think that's some of what was the Bill Gates manifesto. I just think that everyone's kind of aware of that and hoping it doesn't happen, but that's not really hoping it doesn't happen.
Open the market, guys. Let's do it. Jesus Christ.
Let's get the opening bell here.
Get
At the
going.
big board on Wall Street, it's Optimal Tax Asset Management celebrating the official.
All right. Let's see what's going on here. Market is open. Meta is gapped up. SPY's down slightly. Bitcoin is down slightly, and oil is holding. Looks like it came back a little in the past 4 8 hours, something like that. The 10-year or 30-year down slightly. 10-year up a little bit. Semis holding. Software down but moving up. I don't want to look at individual ETFs because I don't want to be spoiled by sectors. I mean, I want to see them as the individual stocks that encompass them, that comprise them, rather than looking at the sectors. So let's do that. And this microphone's a little much, isn't it? I want it to be loud. I just didn't want it to be that loud. I wonder if I can turn it down a little bit here. just a touch. Is that better? And if that's not better, I can turn it down even more, which could be even better, or all the way down here. But for now, I'll turn it all the way back up, almost to the top setting, and down a touch. Let's see how that is. It should be like 3 different options at least there for the microphone. Everyone should be happy. We're lit. You can see the charts. You don't care about me, but you should be able to see the charts pretty good. Now this seems pretty good, as long as I don't touch the microphone. All right, positions are okay. Yeah, it should be all right. Microphone wise. Alternatively, I can turn this down to 13. Sorry, we're just getting this good here. And then turn the microphone up, and that should be pretty good too. Which is pretty much what I've got going on with the other microphones. It's just that those don't have a gain on them. Yeah. All right. So we'll take a spin around the market in a second after everything works its way out. And let's talk about NVIDIA, because that's what everyone's going to be looking at right now. Okay. Let's get these guys.
Leaving out the fact that the state AGs could really have a
lot
run
more creative
against us.
about the path forward if they're
I
worried
think
about
that
the last 7
when
days.
I say David killed
And
Meta,
Amanda,
what I
you
mean
know
is
that this
that
has
there
been one of
really
the
is
strongest
a
earnings
belief
season in
that the
years, but
equity
fewer
offering-
than
that
half
an equity offering
of
might have.
companies are being
And if
rewarded
that
on
happens,
earnings
then,
day.
yeah.
What does
listen,
that tell
we
us
sit here
about
every day talking
how
about the
this market
enormity of the
lines
capital
higher
that's
from
coming
here
at
if we
the
don't get
AI
those,
build, right? Not
yes.
just with
rallies
Meta, of
after
course,
sorry,
but
I've got
every
double
company,
audio
including
going.
Yeah,
the
well,
one you're
we're
going to be
5
interviewing
quarters
later
in a
tonight.
row now of effectively setting a higher bar, a function of positive revisions over the course of each quarter, and then beating that high bar. And so I think that does make a difference, right? How much momentum is left in the trajectory of growth from here? We are seeing an acceleration in positive revisions for Q3, but it is at a slower pace than what we have seen in past quarters. So still positive, still a higher bar, still a lot of fundamental strength here. But I think this rally is just starting to exhaust itself a little bit. And then when you factor in all of the macro policy uncertainty, the macro backdrop has gotten really complex and really fast, despite this disconnect between how strong earnings growth has been and also the economic growth backdrop. And so I think investors are just sort of feeling like, how do I play this macro backdrop from here? It's starting to put a little bit of the brakes
That's
on.
how
It doesn't
I
mean it's the
feel.
end of the cycle or the rally. That fundamental story is still strong, but I think the macro headwinds are starting to bug investors.
Well, you get headwinds today with CPI that ever so slightly, but indeed still is hotter than expected,
CPI
pushing yields up across
or
the curve,
PCE?
specifically on the front end. That's up nearly 5 basis points. And then you also have to contend with what the Treasury is doing, trying to move around or move down the long end. That did have maybe some effect, maybe
PCE.
with oil that was pushing yields down. But Amanda, it is this back and forth. What is the transmission mechanism for that pressure and volatility in yields and treasuries to translate over to equities? Or is earnings growth strong enough that you can look through it?
I think in this environment, there's less of a direct correlation between higher yields and what happens to the stock market. It's not a perfect correlation. It's certainly not an inverse correlation, but I think relative to history, we're seeing a little bit of loosening there. So to the extent that the fundamental backdrop continues to be.
Okay, let's not get too focused on the fundamentals here. To be too crazy. Make sure we've got our notes here. Jackson Hole on Friday. Anthropic as well. And Anthropic IPO, I mean. Looming, potentially. We're going to take a look at Hyperliquid. We're going to take a look at basically who really cares about looking at semis right now until NVIDIA earnings is out. It just doesn't matter. But we do have to at least keep an eye on everything. So that is what's going on here. That meta settlement. We do have to look at metals too. Just keep getting alerts about that. So everyone's watching that. Of course, Meta did gap up. So as we get to 10 minutes after the market opens, we're going to take a look at the SPY, take a look at the market. But yeah, until that, we'll see what other things these knuckleheads have to say about potential other stocks. Don't really care about bonds too much, honestly, right? But let's see. VRT.
People were making note of GE Vernova down 7 straight. Going into
my trust
today.
on GE Vernova, and I'm like saying, okay, you know what, you can just crush them, but in the end, the orders are real, and the orders can be, everyone wants to be in the GE Vernova queue. I do think that what matters is water, what matters is electricity. The Vertiv has a solution for water. Electricity is you have to write a check to everybody.
Yeah.
Say, listen, we're going to do it, and you don't have to pay any electric. That's what they have to do. You don't have to pay any electric bills.
All right, just talking about drama still. Yeah. I guess we're still talking about Guggenheim. We can listen to this a little bit.
Lakers, a team that Mr. Walter controlled. We've gotten this morning, hour and a half ago, the first real statement we've gotten from TWG Global. TWG Global is the entity that controls Group 1001, under which are two key insurers that are the subject.
Why did this pause? What the hell? It's the damn internet.
Recently from the companies affiliated party transactions. And in both cases, both at Delaware Life and at
this is interesting, but doesn't really help your portfolio.
The numbers were restated dramatically from
unless you care about
TWG Global
and
its insurance
cascading insurance
as well. In June, Delaware Life disclosed that it corrected its 2024 related party investment disclosures after an internal review. It initially reported roughly 3% of its invested assets were tied to related parties. After the correction, the figure rose to 40%. So it wasn't a minor disclosure change, of course.
Yeah, but we can take a look at the market now.
A lot
So
of the people who are investigating and a lot of the reporters, of
we
course,
can do that.
Time on this is whether
it's been 10 minutes after market open, so let's tune in here. Yeah, and just see what's going on here. Okay, so SPY again not moving, Bitcoin down a bit, oil down a bit and holding. Just gonna clear this watch list out here and go from the top here. PBR's oil names are down quite a bit. There's nothing really to do here. Uranium is starting to look a little extended, potentially, right? Wow, this chemical name kept going. Don't want anything to do with that, I don't think. I mean, this thing just cruises up. This APD looks pretty strong. Maybe we already talked about that. I'd have to pop that on the long watch list. How it works, guys, basically with longs is they're less likely to work, right? But when they do work, they go much farther. That's basically how it works. SHW, no. MP looks kind of strong. Rare earths. This tech is suddenly on here. USAR2. Copper with a super strong day yesterday, but it's gonna probably take a break at some point. SCCO. What if I just move this microphone away a little bit? That make this listenable. SCCO a lot like FCX, right? Gold, look, doing the same thing. AU already down sort of near an important level. This could definitely reverse, but it's worth taking a look at. I just turned the volume up a little bit to see if I can hear that mic a little bit better. CDE looks kind of strong though. These are all gold miners. Silver. How's this? Steel inching up. Move it even further. It stays. Another middle name. Don't love taking this, but just over the 200 day. Not much going on here. Aerospace, defense. Unless you're a bottom, good for bottom. It's just tough to look for. Components, whatever. There's some strength out of Bloom. What else here? John Deere kind of in a pausing spot. ADP and PayX, hard to say either way for these. Airlines hanging out. No man's land with oil coming back a little bit already. When oil's in no man's land, the airlines are no man's land. Uber kind of a failed breakout here, but already failed, it looks like. Unless it does something else. And Airbnb not looking super strong, but hard to say yet what that's going to do. Booking doing the same thing. Expedia hanging up there. What else? CMG did come back yesterday and gapped down today, so that was that. Dash is just continuing to push, starting to look pretty extended. Yum is already coming back. Could definitely come back more, but definitely not at the top of the list. Amazon still holding. Melly is holding. Hard to say either way there. 5 coming back some strength yesterday though. Probably leave that alone. Earnings is kind of coming up. Carvana, definitely want to leave that alone. That's almost long looking. Leave that alone. EJs came all the way back. Target's back even more. KDP sort of holding. Keurig with Monster coming back a fair bit today, but we'll see. Wow, Kraft really opened down. What else here? Estee Lauder. This is an interesting one. Strength here is really extended coming out of earnings, but it also looks pretty powerful. Volume drying up too, so it's less of a parabolic push. What else is here? Hyperliquid still holding up pretty well after yesterday's massive push. That earnings is tomorrow. It's a definite no touch either way. And these software names, nothing new here. Shopify taking a little breather. Not too much here. That's with Hyperliquid, the Ethereum Treasury, BMNR is in the same category for sure. Miners, Circle with Bitcoin, CRM on a bounce. What else here? Hey, Evangelo. Concrete market. Concrete market. I don't know what the concrete market what public companies are in the concrete market. That is an interesting question for sure. We have some tickers that are, billion-dollar companies. A billion, whoops, typing in all caps. Companies, public. We have some tickers we can take a look, but I don't know about the concrete market. Amar is holding up there. Palantir bouncing here to come back a little to that sort of top on, or short-term top at least, on Friday. What else? SAP is already down. Unity, a little bit of green here. I'm not sure how much further, if at all, this is going to go. Just looking for like 43.2 on that, so quite a bit lower. But could definitely just even out here, not sure there. And then with KDP, was looking for, whoops, KDP quite a bit lower as well, just barely getting back below entry. I was looking for 39.3, so quite a bit lower here. So those ones are taking a little bit, not much time, but this one's really taking time. And looking like a pretty poor choice given the potential merger news around Warner Brothers. Maybe some associated sympathy strength here, some theme. Sympathy. That's not the word I'm looking for, just theme strength. Anyway, so yeah, back to these software names. Yeah, theme momentum. That's the word I was looking for. Gosh. Workday, some strength here. Coming into earnings, or nothing to do there. There's the Zoom earnings that really were rough. Looked like it was moving down before those earnings came out a lot. Just pretty interesting. Usually you want to leave things way before earnings, but in that case, it would have been good. I'd say it's 2020. Microsoft looks kind of strong. And Path looks pretty strong too. What was ANET? MSI is kind of at a strange spot. A lot of tight days. It could go either way. And then Dell looks pretty strong. So that is pretty much that. All these semis are pretty much in no man's land. Unless you're a bottom finder. AMD, maybe a little bit of strength. That's it though. That is all. I mean, there's NVIDIA coming in earnings down quite a bit. So it's like SMTC earnings are out afternoon. Moving up here, let that close. Or, you know, buy it. I don't know. Just leave those alone in general. Spotify after that shelf. Could look for an entry here. But so I didn't mean to highlight that. But that's it. So I'm all margined out. Not really. I mean, I have 1 3/4 leverage. Basically, little underwater. Fox A. KDP is somehow exactly at my entry. And then this one's okay, but I don't know how much further that's going to go. So I'm not in a position to take any more positions, to take any more stocks on the long side or the short side. I do like the short side because I can recycle margin more often. So given that you know, my personal win rate is longer on the short side than the long rate side on these billion-dollar plus companies. It makes more sense for me to look for short-term bursts rather than hold the long, which will actually grow in size as it goes up and take up even more of my buying power. As a short starts to work, the buying power it takes up contracts, decreases, meaning that I have more space for other positions as it works, if it works. So that is my personal strategy, but people aren't really here for my personal strategy for the most part. I mean, you take bits and pieces, but everyone's a little different, which is why I kind of like the idea of being more of a sort of email, you know, more of a show. Maybe show is not the right word because this is so just fledgling, but you basically get what I'm saying. I do like coming up with long ideas because for long-term growth, you definitely have to be long-term, long-minded. There's also a safety characteristic of it as well, where you can only lose what you put in. Short, you can lose more than you put in. Obviously, through my experience and, you know, rough napkin math, do believe that I'm likely to make more than I lose over time. Otherwise, I wouldn't do it. But for most people, they view the market, you know, as a long America view, which I do as well. But I also, in practicality, view it as Not sure why my comments aren't going through. I'm making comments on OBS and they're not going through to, yeah, YouTube has a little X connection in Aerostate, even though it's streaming to YouTube. It's super, super bonkers. But anyway, what I was saying was, in order to do well long or short, and in fact most successful people actually do both, you kind of have to be a little bit of a devil's advocate and say, well, I maybe short this, but, you know, Elon's the CEO, you know, maybe don't short that today. Or, you know, maybe I'm long this, but, you know, there was just a $16 billion settlement that this company made on a, you know, addicting, you know, young people to social media. Maybe, even though capped up, maybe I might not take that one today, you know, stuff like that. So that's sort of the balanced view, although most of my positions, almost all, and all in the last month have been on the short side. If you don't look long or look for growing and developing an understanding of how to long, not only tactically, but fundamentally. And the tactically part is, you know, another way to say technically, and technically is another way to say like correctly or actually, right? Which is sort of the friction that occurred between, you could say, Citadel and, you know, Mr. Leopold, which is that, you know, Citadel, those people understand leverage and buying power and everything as far as practicality of the position, and Leopold understood more of the what might happen in 20 years, which is useful. You know, that's the long energy that drifts the market up over time. But if you only have one or the other, you're going to have a bad time. So I would love to be able to tune into some of these talking heads again and see what they got going on, because we've sort of taken a look at the market and, well, yeah, we saw what it did. I don't know how much we want to talk about this Meta thing, but it looks like they're talking about tariffs at least, so there's some macro here. Let's take a look at that in just a moment. In Dubai, I guess.
We are 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Danny Berger alongside Yahaira Anand, and it is an equity market just barely pushing into the green. And coming up, we discuss that. Stocks are wavering as fresh eco data does little to alter bets on the Fed's next move. Meanwhile, NVIDIA CEO Jensen Huang takes the spotlight as investors look for the next signal on the AI boom. And Meta agrees to a landmark settlement over claims Facebook and Instagram fueled teen addiction. We begin with the latest economic data. Consumer spending stalled in July, while a key inflation gauge rose as expected, but slightly hotter if you take it out to the third decimal point. The Fed maybe gives them more room to hold rates steady, but let's get to Michael McKee, Bloomberg's international economics and policy correspondent. And Mike, I just say that with skepticism, because I was looking at an Omar Sharif note that basically said this data might mean the Fed needs to hike. What did we see?
I've gotten several notes, Danny, that also say this data means the Fed doesn't have to hike. So that's going to be the interesting question going forward. We did have a lot of data this morning, and if you break it down into just the numbers that are going to matter for the central bank, headline PCE stayed unchanged, and core PCE stayed unchanged for the year, which does align with the Hawks' view that they've got to do more to bring down inflation, because it's been well above the 2% target for more than 5 years now. Personal spending dropped off a little bit. Maybe the economy is slowing. Well, the revision to second quarter GDP pushed real final sales to domestic purchasers up to 4.2%. Now, that's important because that takes out inventories and trade and government spending, and just gives you a picture of what business and consumer spending is like. And it was very strong in the second quarter, and that appears to be carrying over, at least in the durable goods areas, into the third quarter. Capital goods shipments for the month of July up 2%, and that'll go into GDP as a fairly strong contribution. So right now, it looks like the economy is still performing well, and inflation is unchanged. So to pick your fighter here, either you're a dove or a hawk, and both sides can probably make a claim. And we'll be listening for people here at Jackson Hole for opinions throughout the week.
Exactly, Mike. So does that combination of sticky inflation and weaker spending that you Chair Kevin Warsh in an uncomfortable position on Friday when he makes his speech?
Sorry about the audio.
Well, if he goes by what Kevin Warsh usually goes by, which is no forward guidance and not a lot of information anyway, it probably wouldn't put him in an uncomfortable position because he doesn't want to comment on the current economy. But Wall Street is expecting him to, at least to the extent of saying something like, well, if inflation doesn't come down as I have promised, we will use
only
all
like
our available
half of my
tools to
AirPods work,
attack it. That may be the most we get out of him.
and they're all on different
It'll be interesting to
sets.
see the market reaction if he doesn't even go that far.
So I've got
Mike,
one
thank you
right
very
that
much.
works
That's
on.
Bloomberg's Michael McKee.
You don't guys
And
don't
tune
care.
into our Bloomberg Surveillance Jackson Hole special
fine
on
with new
Friday.
AirPods.
We'll
They're
be
coming
joint meeting to the Fed Chair Kevin Warsh's keynote address. That coverage begins at 9 a.m. New York time. Yields are moving higher this morning, led by the front end after that
It's on
inflation
Friday,
data.
though.
But key market metrics have been showing that maybe Treasury Secretary Scott Bessent's plan to expand bond buybacks is making a market impact. Treasuries have outperformed equivalent maturity swaps, narrowing the 30-year spread between the two since the smallest since July. Joining us now is Katie Kaminsky, Chief Research Strategist at Alpha Simplex. And Katie, we did see yields come in a decent amount yesterday, their biggest decline in 2 months. They fell to their lowest level in about 3 weeks. Yes, they're moving higher today. But are we witnessing something of a Treasury Secretary Bessent put on this market?
Oh, that's a good question. I'd say for me, this is a week to talk about Treasury yields, obviously, with Jackson Hole. But from my perspective in the cross-asset space, I'd say that the moves in oil
You guys want to see the
bigger impact on yields this week.
Titles.
And the fact that we're repricing geopolitical risk, maybe Bessent is a part of that as well. But I would definitely say that it's been much more of an inflation-driven narrative, which means that we need to look at long-term rates and see how they're repricing as oil prices move as the key indicator.
And speaking of long-term rates, Katie, are treasuries at this level attractive enough for you to step in?
There has been flow, and I'd say that at these type of levels, if you look at the one-year chart for most Treasury yields, they are attractive and they are potentially, at a level where you're going to see some buying pressure. And I think that may also add to some of the direction that we've seen this month. I mean, at these type of levels, should we see geopolitical risk reduce and also a narrative where the Fed has room to sort of pivot at some point? Towards
building
lower
your
rates
app
some point in the future, that
on base
could
44.
make yields go down and
Describe
mean
it.
that this was a good buying opportunity.
Just doing a little troubleshooting. I want to get the
There
chat
has been
on
including reporting
YouTube.
from the New York Times a desire from this Fed chair to really communicate to the market that he is serious about taming inflation. It didn't work in his last press conference. There were questions as to whether he would really do that and have the ability or want to indeed raise rates. What would it take from this market to get that message from Kevin Warsh? And would that have the impact of lowering long-term rates, something that, again, the Treasury is trying to do right now?
I mean, I think that is a much more extreme scenario right now. I think it's much more likely that we're sitting in a situation where we're on hold or we're patient. But I do agree that those comments about potentially...
I'm not sure these guys know anything besides what they just said 20 minutes ago. See if they got any news. We're looking for news. No, they're still talking about Meta over here. So, guys, I think we just got to take things into our own hands here, which is why you're watching YouTube in the first place, and see if anything's cooking here on YouTube. So, yeah, let's do that. This is, some of these alerts the past week. This is going to be YouTube. We're going to do that. We want to get rid of this stupid Epic Pen thing. This thing always starts on startup. You know those programs that they always start when you start your computer, and you can't get rid of them. You just start on Windows 11. No, absolutely not. I do not want this to start on Windows 7. Do I have to save that somehow, or is that you're going to save that? Let's see. Okay, so that should be pretty good there. Okay. And as far as dropped frames, we're definitely dropping frames, but not a crazy amount. So I think the stream is okay. 2.2 megabits. Yeah. Using 500 megabits of memory, 11% of the CPS, whatever that CPU. I don't know what half these numbers mean, to be honest, but you can hear me, you can see me, and we can see this YouTube screen, see if anyone actually has anything useful to say. I mean, the person with the most viewers right now is this guy, right, Kevin? But I don't think that looking at balance sheets is really going to help us in the next 48, 72 hours, right? Red guy, they're going to be talking about altcoins. No thank you. And they're going to be talking about day trading SpaceX. All right, we'll take a look. But we're probably going to bow out of this pretty quickly. So, give this guy like 30 seconds. They have women too doing the kind of like Bloomberg, doing the things that are, you know, fact checking. Let's see. Yeah, sure enough, he's day trading SpaceX. Oh my God. So we got to ignore that for sure. And could take a look at Amit too. He's going to be talking about Meta and Palantir. Yeah, he's talking about it. He's day trading NVIDIA while talking about Meta. And he's got his chat talking about conspiracy theories. Yep. And just word salading. Fortune 500 companies. Mag 7 companies. So, as usual, we're kind of left at a crossroads here, where it's like, yeah, stuff is happening, but not that much stuff is happening, right? I mean, we can take a look at the actual market, which in the most cases is the most productive use of time. But there's not a ton going on. You can see what's getting crushed and what's not. Starting with what's getting crushed here. We already knew about Zoom. XTI has been a rough one. Oh, you know what I'm going to do, actually? I'm just going to make sure I take stock of where these are right here. This is a short watch list. So what this is stocks that are potentially overextended. And the reason I don't have a long watch list,
recording in progress,
whoops, sorry for that recording notification, is generally the number of long ideas at any one time that I surface are fewer. CCJ has already come back a little bit. FCX is definitely interesting. Gold come back a little bit more. Vail over the 200-day. Not sure about that. Airbnb did come back some, and Dash pulling back a little. Yum came back up a lot. Estee Lauder still at that level, and then MSI a little bit of a wick to the top, and Spotify coming back a bit already. So just to finish this statement there, there are long ideas, and I mentioned them on this this early alerts page I briefly showed. But what's and I'll show you the page I'm talking about. The hesitation with a long watch list is that there's quite a lot of companies you might put on there, and the win rate for longs is actually quite lower. Now, win rate is not necessarily correlated to profit, expected profit over a long period of time, expected value, you could say. But in terms of making predictions, it's pretty... The problem can become, if you have a whole bunch of long ideas and your win rate on longs is, say, 20%, 1 out of 5, it doesn't really improve your ability to pick a stock if you make a whole bunch of predictions in that arena. Whereas with shorts, if you have a whole bunch and you have a pretty high win rate, that does improve your ability to sharpen your sword on the short side. I'm not sure that totally made sense the way I just articulated it, but hopefully you understand the thesis here, which is that, hey, if we want to throw a bunch of darts at a wall and then come back a month later and say, look, I picked, AXTI, I picked Bloom Energy on this day among a list of 10 other names, which is what a watch list would be, right? It'd be like 10 names. Great, you can do that, and a lot of people do that. I don't want to do that. I want to actually get good at longing, and for that reason, I only pick one. So, hope that makes sense as to why that's what we got going on. I do film the shorts because that's where most of my positions are. I can show you my positions. I already showed them, actually. Fox A, which is Fox, like the one you watch. We could watch Fox. They sometimes talk about random stuff that's not related to the market, unfortunately. So it's not the best market stream fodder. Not that that was the reason I'm shorting it, but... And the other one was Keurig, and the other one was Unity. And I do display the arrows on the chart for those, but what's more important is your portfolio, which is why you would watch this. And just because my portfolio is leveraged, 170% short, or 70%, however you want to call it. If you had $30,000 in cash in your portfolio and you owned $30,000 of Google stock, you would say you're leveraged 100%, or 0%. So however you call it, I am leveraged. I have $30,000 in the portfolio, and I am short whatever 1.7 times 30,000 is of stock. So whatever that is, like 50x 53,000 or something like that. I can pick it up, show it right now. 53,000. I can't show it because I don't really want to show my broker. I have shown the broker on the stream before. It's just probably a good habit not to do that, right? In general. So yeah, getting the habit here of streaming while also trading, and while also sort of like obfuscating the account number and everything. I actually had a way to do that. I forgot to save the layout here. But there was some setting. I would show you what I'm looking at right now, but again, it has the account number. So I'm trying to, there was a way, I'll ask ChatGPT how to do this. There's a way to, in Interactive Brokers, which is the broker I'm using here, there's a way to essentially display the window in like simple mode. So it, on the headers or whatever the, the very top of the windows. So I was making crazy tweets from the transcript of my stream. Remind me how to remove the account number from the Interactive Brokers window. Okay. Okay. There was a way to do this that I had it going yesterday. I just didn't say. Title bar account display settings. That might have been it. Display settings, title bar account display. No, that wasn't quite it. Something else. I don't think it was this alias here. Sure, how to do account alias? See if they can help me with that. Account alias, no, that wasn't it. Title bar text wasn't it. It was something else. IBKR settings, account alias. Looks like I might actually have to log into IBKR to do this. Let's see how to do those. So I'm going to open a new window again, so I'm not logging into my broker on a live stream. That would be like stupid 101, right? It's mostly fine. It's not people who are watching right now. It's just, you don't want to be like a viral sob story or whatever. Let's see. It's like settings. What did they just say? Settings account alias. There's quite a lot of settings in IBKR if you haven't looked at those settings. They got a lot of stuff going on. Yeah, so it's already showing account numbers here as I log in. So, what was it? Something here. Yeah, I don't remember doing this, but this is interesting. I don't think that's what changed. I have to restart the broker. There was something to do with basic title bar or something like that. Not title bar text. I gotta change that. Let's see. No, Yes, that's what it is. Global configuration display, use system title bar, display style. Let's do that. Global configuration display style, use system title bar. Yep, that's it. Let's see. Okay, and then it restarts IBKR. And now it's gone. Okay. And now you guys can't see this again, but now I'm going to save that as a layout. And then I can just open that layout potentially on stream. Again, probably shouldn't be streaming my broker, but people do it. I don't know. But yeah, anyway, the account number is mostly gone, I think. Again, not that it totally matters because there's two-factor authentication and IP restrictions and, you know, quite a lot of security-related items, but that should be good. I really don't want to do fundamental analysis on SpaceX in a live stream. But if I have to, I'll do it. Oh, gosh. Okay. Let's see what else is cooking here. Can yap about NVIDIA. Or we can listen to people yap about Meta. So, neither of which are tradable opportunities right now. Tune in briefly to the NVIDIA story. Yeah, we'll see what these guys has to say.
Yeah, I mean, the truth is we've been expecting it all year and we've been dead wrong. I think the good news from investor positioning is that most hedge funds are underweight or using NVIDIA as a funding short, and many of the long-only investors are underweight. And so I think we are going to get another, monster beat. I think Jensen's going to come out pretty vigorous in terms of their competitive positioning. And so I do think that does set up where the risk reward is higher. On the other hand, there are ongoing concerns, whether it's circular financing, market share for inference, whether they can sustain their gross margins in a world where memory pricing is ripping higher. So, I'm not sure that they can solve all of those questions tonight, but they are going to do $16 to $17 next year, which means the stock is trading at 12 times. So I think risk reward, you want to be there tonight.
Wow, former Assistant Secretary of State.
I sound like a broken record because I've been saying that all year.
Yeah, well, you're not alone in that.
I didn't know there was an assistant.
And 12 times does sound pretty compelling, trading at only 12 years worth of next year's earnings. Even with the headwinds you describe. Anything unexpected perhaps coming our way from NVIDIA or
I wouldn't worry about price earnings
and or articulation around certain themes perhaps on the conference call that might not be expected?
Yeah, sure. So, I think that if you go back in time at GTC, they outlined revenues for data centers second half 25 through 27. They could come out and actually give a number just for 27, and with the street at 523 million and some of the most bullish people thinking 700 million or more.
I wonder if I can get these headphones back on that actually
that could really move the needle.
Have volume I can hear. I can't really hear what this guy's saying, but you can.
Really helping neoclouds, and that is supporting the potential for a recurring revenue model. And so I think that would be something to really listen to.
Again, I have 3 pairs of AirPods,
the third point would be all
each
of the
with
efforts that they're
basically
making,
one AirPod that
around
works.
open source models. And I think that if they can start to kind of change the storyline around recurring revenue, adding more value to their customers, not just from hardware but software, start to change the sentiment on there.
Sorry for the echo for a second.
To look out for. I'm not saying it's coming, but
Or 5.
there is a good potential that Jensen could focus on at least one of those 3.
Going back to your point about recurring revenue in the neo clouds, There
All
is
right,
some
there we go,
thinking
finally.
out there that some of the support
What I'm gonna have to
they've
get at
given
some
with
point is
regard
one of
to
those
financing and some of the new deals
little
that
like
they've
things
struck
with dials and
could be
buttons and
having a
stuff so that I
pull-forward
can do
effect.
this
So
without
you think that it actually could be creating more of a
changing it on my
predictable
computer,
cash
but
flow element for NVIDIA,
that's going
and
to introduce
that
more
concerns
complexity
that
as
it's
well.
more of a
So
temporary demand are unfounded?
I wouldn't tie the two together. I don't think there's a pull forward. Compute is sold out, and TSMC remains clearly the bottleneck. And so I don't see really that as an issue. I think, the truth is, NVIDIA has to kind of prioritize who they're going to deliver their compute to. And I think, they take care of their hyperscale friends, but also they take care of their favorite NeoCloud friends. I think the recurring revenue stream is really more of, the financing aspect. And in return, if those customers generate a greater return on those GPUs, they share
also
or
easy to
benefit,
just lose the
in
efforts.
that greater return. And, I think that's where, you could start to see that in the dialogue. But, the contracts that they've signed to date are de minimis.
So they look the
I
same,
think
so
it really would take time for that to be
forget
a
which is
meaningful
which.
driver for them.
Finally, CJ, I guess if I'm negative on the stock, if I want to build a case, I mean, what out years am I going to say, well, then that's the year that revenues are really going to fall off a cliff, or I have a discounted cash flow model that suddenly shows that number is just not something I want to be investing.
See, I'm looking forward to having 2 pairs of AirPods
I mean, I
with
think you'd have to
4
make the call that
working, so 2 in each pair that work. Basically working AirPods,
I think
2
you'd have
pairs.
to make the call that these large frontier models
should happen this
cede
week.
share to the open source models, and that the compute intensity there is significantly less.
Open source
and that
question
we
is
don't move
big.
to a world of AGI, and I think in aggregate those are really hard bets to make in my mind, and so I would leave you with one last thought, which is semi equipment, optical. Other parts of the networking market all trade at 25 plus kind of multiples, whereas NVIDIA, Broadcom, trade in the low teens, and I don't think that's sustainable. So if you're really making the bet that this is a peak, then I would say that defensively, NVIDIA, Broadcom, others will trade better than some of the other areas that are benefiting from AI. And so they're in that regard,
Maybe in the next 6 months,
either way,
what he's
for
saying
NVIDIA,
does
Broadcom,
hold weight.
is quite strong.
Interesting. CJ will be watching. I know you'll be watching very closely tonight.
But there's
after
so
Bell's.
much
Well, thank you.
else that
Thank you.
is going to happen between now and then.
The only name reporting results tonight. What the street is expecting for Salesforce later this hour. Plus, retail's biggest winners and losers as questions remain over consumer spending, and names in the space see huge swings on results. But first, fresh developments in the growing saga surrounding Guggenheim chief Mark Walter. Details next.
I don't know if they're going to have developments there that are that interesting or not. People have been talking about developments there for a while. Let's see if there's anything coming out of Bloomberg here.
Gilbert, I got to start with Abercrombie and Fitch, just considering what the share prices are doing, up 30% more than that. What's been fueling them? This very nostalgic brand, I guess, coming back.
This is probably sexist, but I don't want to listen to that. Because I don't want to listen about clothes, because these stocks tend to just give back their gains pretty much. Like, yes, we were looking at what's down, we can look at what's up, but tends to happen is, we just saw what happened with Target. Ross Stores got crushed. What about there was another one like Target, not Abercrombie. Oh yeah, Aerie. What is the one that's not Abercrombie and Fitch? Yeah, like I'm useless in this category. So is all of Wall Street. But maybe that's why the stocks sort of trade like shit. Anywho, I guess I'm gonna resign myself to listening to this cat talk about SpaceX Or we can talk about SpaceX. Oh, we don't want to do that though. The bull case for SpaceX? No, thank you. Let's see. What do we want to talk about before I look at this? Besides position sizing, could listen to this guy a little more. This is what I was listening to earlier today. Yeah, he was talking about last year, so it's definitely not relevant to today. But it is interesting to me, which means it might be interesting to other people. So we talk about silver.
You know, maybe a little bit lower, but maybe a little bit weaker that has maybe a little bit more potential. It's just a risk reward.
Yeah, perfect. And I know you said you didn't trade this to what you wish you could, but what were your entries and general exits for this name here with SLV? And did you press as it broke below that first hour after that gap down on I think that would be the 30th or whatever that day where it really cracked?
Yeah. So, well, I have a lot of trades through SLV throughout, December and January, and I had some big wins and I had some big losses. I mean, I'll just go through the final week because that was kind of the climactic run. So, yeah, I mean, right in here, this day on Monday in the afternoon when it had one of its biggest moves ever intraday, and it started to reverse. I shorted it and I hit it pretty hard. And this is a continuation candle right here. And silver closed that day at the low of days and actually went down after hours. And I had some pretty good size there. I mean, I was very confident this was the end. And then the next day, it was not the end,
Oh,
so
sorry,
it kind
you
of
can't see what I'm watching.
consolidated. Once you see this green candle right here on Tuesday, I completely exited that position, thought it's not worth it. It's not breaking down. It's not doing what I want to do. Fast forward to Thursday. I don't think I traded it Wednesday at all. Fast forward to Thursday. I absolutely hit this gap up, shorted it.
Sorry, guys.
Had good profits right off the bat, only to have silver kind of bounce again where I sized down, into the afternoon. So I still was swing trading this. I did have a position on overnight.
Let's just
Chase a gap
reiterate what he
down
was talking
candle
about
right here.
Well, I wasn't trying
and
to
silver
screen.
closed that day at the low. This day on Monday in the afternoon when it had one of its biggest moves ever intraday, and it started to reverse. I shorted it and I hit it pretty hard. And this is a continuation candle right here. And silver closed that day at the low of days and actually went down after hours. And I had some pretty good size there. I mean, I was very confident this was the end. And then the next day, it was not the end, so it kind of consolidated. Once you see this green candle right here on Tuesday, I completely exited that position, thought it's not worth it. It's not breaking down. It's not doing what I want to do. Fast forward to Thursday. I don't think I traded it Wednesday at all. Fast forward to Thursday. I absolutely hit this gap up, shorted it, had good profits right off the bat, only to have silver kind of bounce again where I sized down, into the afternoon. So I still was swing trading this. I did have a position on overnight, that I made money on that Friday, but I did not add. I added a little bit, but, a fraction of what I wanted to. And I made, just a fraction of what, the potential was for this. But again,
So it's interesting. So he covered.
Had one of its biggest moves ever intraday.
Looks like when he first shorted.
Yeah, perfect. And you press as it broke below that first.
Because this is interesting. So he's basically saying how he undercapitalized on this opportunity. But what it reveals is his stratagem or whatever, which has been extremely good in like a, inhospitable opportunity set.
Hour after that gap down on I think that would be the 30th or whatever that day where it really cracked.
Yeah. So, well, I have a lot of trades through SLV throughout, December and January, and I had some big wins and I had some big losses. I mean, I'll just go through the final week because that was kind of the climactic run. So yeah, I mean, right in here, this day on Monday in the afternoon when it had one of its biggest moves ever intraday, and it started to reverse. I shorted it and I hit it pretty hard, and this is a continuation candle right here. And silver closed that day at the low of days and actually went down after hours. And I had some pretty good size there. I mean, I was very confident this was the end. And then the next day, it was not the end, so it kind of consolidated. Once you see this green candle right here on Tuesday, I completely exited that position, thought it's not worth it.
Yeah, completely exited on that green candle. So that's interesting.
It's not breaking down. It's not doing what I want to do. Fast forward to Thursday. I don't think I traded it Wednesday at all. Fast forward to Thursday. I absolutely hit this gap up, shorted it, had good profits right off the bat, only to have silver kind of bounce again where I sized down into the afternoon. So I still was swing trading this. I did have a position on overnight.
I'm not sure which afternoon he's talking about, but presumably the day before the gap down. So maybe he had like half size or something. Or less, but he did hold through the gap down, so that's interesting. So instead of just having his initial position with a wide stop, he had a bigger position and then a normal size position on. So I think he basically had the same. I think what he's able to do here is lower his win rate to like 45% or something like that. But do so via having wins that are about 1.5 size its average loss through pyramiding on the short side, adding into a short, shorting and then shorting again, with maybe at 1.5 size as initial position or equivalent size of his initial position. So creating an aggregate expected value of greater magnitude than having a wide stop, a small size right from the very beginning and just holding for like 3 weeks, which again would increase his win rate but lower his aggregate expected value, and would actually maybe result in the same or slightly less total profit than what he did in reality, he achieved, which he's describing as undercapitalizing.
Right. That I made money on that Friday, but I did not add. I added a little bit, but a fraction of what I wanted to. And I made just a fraction of what the potential was for this. But again, when you're dealing with silver, you're dealing with a commodity, you can look at this chart and see that you're dealing with massive risk, gap risk, I'm sorry, every day. I mean, every day you're for the most part, it was gapping up, gap up. Now here's a gap down, but here's a big gap up, here's a big gap down. So when you're trading futures or commodities, you have to deal with that gap risk. And it's just tough. It's a whole nother animal. I don't trade commodities, really. I don't trade them. And this is kind of a new rule that I'm going to add. I'm not going to put it out there that I will never trade commodities again. I've traded oil and I've traded natural gas, but when I do that, it's with very small size. And I went into this trade trading large size, and only because I knew the potential reward that it would offer, but I was not expecting the toughness of the trade. I was not expecting, this final week to just have an up and a down and up and a down and up and a down and up and a down. And when it finally died, to be down 35% a day. So it was definitely a much tougher trade than what I expected. So going forward, if I trade commodities again, I will never let it take up several weeks of my focus, which I did. And I will trade it on a much smaller position size because I know, hey, I don't want to risk this much mental capital on a trade again,
Right. Yeah. So Phil, I'd love to hear, if obviously you were stalking this SLV trade, Did you go back and study the 2011 move to give you maybe some insight on how SLV might act? Because this
What
one
the
actually
hell?
had
2011.
some head fakes as well, which is interesting enough. So yeah, I'd love to hear your thoughts on this.
It is, no, it is. So it's something I do almost every ticker. Is I look at the history. Not only do I look at the daily chart, I want to look at the the history, 6 months, 1 year, and lifetime to see did it ever have a move similar to this before? Maybe even on a smaller scale, but how did it react? So yes, no, I did. I went back to the 2011 chart, and you can see right here when it peaks out, it falls on a day, it falls again, has a continuation day, but then it bounces pretty hard right back up to higher days. Where this day right here is kind of a, it's a failed breakout before, the final peak again is right here on a Friday. And on Monday, we gap down very large and have, 4, red candles in a row all week. And that broke, and that's down, I don't even know, 30-ish% for the week. So, and I knew that with silver, that, the end could be tricky and would be tricky. And a lot of those setups are tricky. The hard thing, again, is to have on, meaningful position size and be able to hold through a bounce like this and another, failed breakout right there. So that's when it gets difficult because, as I, explained earlier, one thing that's helped me throughout my career is to have strict loss management and be able to take my, cut my losses very quickly. So in something that's extremely volatile, it's hard to do. It's hard to say, okay, I'm going to cut my losses at just a few percent of my account. But at the same time, when I know they're volatile and they're going to have a wide range, it's like, okay, you're going to have to give or take or something here. So, it was difficult, but, going back through history, definitely is going to help out because as we know and talked about before, chart patterns have a history of repeating themselves and setups will do the same. So, any prior, chart pattern or something that you can find, it's, I think, going to help, help in the future.
And like you mentioned before, like you were looking at like the character of SLV. It would gap down and hold. Like you're getting a sense of the character of the instrument as you go through it.
Right.
Awesome, Phil. I know you wanted to cover MSTR as well, which is another great move in 2024 that both to the long side and then to the short side, which you took advantage of.
Sure.
So let's dive into that one.
Absolutely. So
what is this?
MicroStrategy again was very similar to that SMCI setup for me. So you can see here in November, SMCI first of all started a big move down here, sub 150, went up to near 500 in just a couple months. So around this time, mid-November is when it kind of started to pique my interest. And once again, if you see this chart pattern, you have 3 big green candles in a row, 3 big up days in a row. This day closed a little bit weak, but on that 4th day, we gapped up very big. And once again, we gapped up, something around $525-ish. And after, 20 minutes after the open or so,
Did have a wick.
we immediately started to pull back on higher volume, went below the market open that day. I started to take a position and continued to add to that position as it broke through 500. And I, took profits on this somewhere in the lower 400s, like 430s, I believe I started to scale out, 430s, 420s, 410s. Now, this stock did intraday. It did bounce a little bit intraday, and then it went and closed, made a new low of day at the end of the day at $375. And this is another really good example of playing both the equity and the options here. This move happened on a Thursday, but these options here went up, I know, well over
after it bounced.
10x. I don't know exactly where some of them went. It's another, it was another trade for me. It was a 7-figure trade for me where I traded both the equities and the options. So, again, this is what I would consider an A+ setup, something right here.
For sure. And yeah, I love that 3 straight gaps up in a row and then another gap up to open and then the reversal after it's already extended. That's like this is the setup everybody should study if they're trying to become a good short seller.
Right.
A few questions for you, Phil.
Sure.
First, you've talked about trading both the options and common stock, and obviously options require additional skill, additional experience. There's additional risk there. How do you decide when you do that? How much you are trying to increase the potential of the trade with options. How do you kind of make those decisions as you're planning out a trade for something like this?
First of all, and again, buying options, it's something I'm not experienced with at all. Again, I do sell options for income quite frequently. This is the complete opposite, actually buying options. And we all know the majority of options expire worthless. They expire, worthless for zero. So, you have to have the mindset that you could, on a percentage-wise basis, lose more than you could on the equities because the options are going to move very fast. So again, on this final day here, if you are buying puts, which is what I was looking to do, if you would have, let's say you're buying puts at $2, if you would have had any sort of a bounce in the stock, they could drop to $1.50 just immediately. You could have a big percentage loss. Now again, I'm going to trade less position size on some of these options. And the reason I do that is because they're leverage and that you have the potential to make, 5x, 10x, 20x, like we talked about in Super Micro, extremely rare, but 50 or 60x. I mean, and again, that's an extremely, extremely rare situation. So I'm going to play with less position size only because I know the huge upside that could come with that and the volatility that's going to go along with it. On the equities, I'm a little more familiar with, and I will, play a little bit more size on the equities than I will on the options.
When you're buying a put, how far out are you usually going? How do you kind of determine your strike price? How do you kind of lay out the trade just like that?
On a situation like this, I'm looking to do it extremely close. The Super Micro computer, I did 0 days to expiration options. I just traded it that day because they were very cheap. And they are going to offer the most upside on this. This move happened on a Thursday. I was trading like the next day options and then 1 week out of options. I'm not going too much time frame further than that, and I'm trading probably close to the money or a little bit out of the money, maybe 10% out of the money. And that's about it. So, the premiums are going to be a little bit higher on those. But that's what I, personally like to stick with.
For the options, like you said, like if it goes against you, the value of the option drops really quickly. Do you have like a stop loss rule for the option where if it drops 50%, 75%, you're out? Or do you just structure the trade in a way that you're accepting that loss on the full option, and even if it goes, expires meaningless?
So no, when I put on an option trade, I'm right back to looking at the equity, looking at the chart, and if I think the move is going with me, I'm totally fine to hold it. If I think that chart is going to hold and possibly reverse, or I think that my entry was wrong, I immediately get out of that option, take that loss off. I will never let an option expire worthless. I don't, I just never ever do that. So I cut my loss.
That's interesting.
10%, 20%, could be 30%. But I, again, it's strictly off trading the chart, seeing where I think that pattern's going to go, and basing it just off that.
Perfect. That's
the options are a little sweeter.
One question I had is more about routines, and routines are like my favorite thing to talk about, even though for a lot of folks it might be boring. But like, how did MSCR, SMCI, the SLV, what are you doing on a day-to-day basis to monitor for those types of situations? Like you said, there might only be 1 or 2 A+ trades a month. There might be none some months. So what are you doing on a day-to-day basis?
Let's say you have to strain for 8 hours a day. What are you doing?
Are you
running
screens?
Don't
Are you
happen.
just looking through? What are you doing? I guess.
So a couple of things. First of all, if I get to my computer 2 hours before the open, I'm looking at the gap scanner. I'm going to know what's gapping today. What's gapping? Why is it gapping? What's causing something to move? And then I'm looking through, what I have on my radar from last night, but I'll get into just a pure day, waking up, looking at the gap scanner, seeing the gappers, seeing the news, figuring out why stuff is maybe moving, and then looking at, what has moved big the last 2 days or 3 days or 5 days are the biggest movers on this week or 2 weeks period. So I want to see what's running, and put those all into my, my main monitor, and just continue to focus on those throughout the day until they will possibly break. After hours, I pretty much do the same thing. Do a post-market follow-up to see, okay, what were the movers today?
I know what I'm doing, except I'm looking at a larger universe of
How far do I think they're
stocks.
extended? Is there any news on them? Are they newsworthy? Is there
Refreshing
something
the
driving this
watch
move,
list
or
each
is this
day.
move purely, is it momentum or is it manipulation? Again, as a small cap trader, a lot of these moves happen through manipulation. Now, super micro and micro strategy are not, they're higher price stock, but I think a lot of those moves are just, momentum. And I think they're driven through momentum and probably driven through some greed.
Momentum.
So I want to figure out why this stuff is moving. But again,
That's the word.
I scan and screen constantly throughout the day. If I try to figure out what's moving, what's extended, and why is it extended, to see if I have an edge on anything. And then like I said, I prepare every night for the next day. I kind of get a watch list of my top 3 or my top 5 stocks. I don't like to have there's nothing wrong. And it all depends on your style. With my style, I don't want to have a watch list of 20 stocks. I can't do that. I want to focus on ideally two to 3 top setups that I have laser focus on, and that I'm willing to say, okay, if this develops into an A+ setup, I can put on position size. I'm not able to put on big position size on 3 or 5 or 7 or 10 stocks. I want to do that on 1 or 2 or just a couple of them. So, I go into every day, like I said, with my watch list from the night before, my new watch list from this morning. I've compiled that with hopefully my best 3 to 5 setups for the day, put them on my main monitor, and just wait for the open.
Excellent. And to dive deeper into that, let's say you do your screening and you find 2 ideas that are similarly set up. They're extended, they've got the qualities you look for.
I think 2 is probably better for what I'm doing to sort of eliminate acquisition risk. But, one would probably be okay. I have to think about that more, or just be more exact about which stocks I'm going basically all in on short. Because how likely is an acquisition to double the stock price, which would wipe you out completely? Pretty small. But if you're double leverage short, then it only has to go up 50%. But again, how likely are acquisitions to 50%? Very small. So this is basically an argument for wiring out and using smaller size in the trading account, and then frequently going quote unquote all in. But if you're not using the capital that's coming out of the account, then it might as well be in the account in 2 different positions. Yeah.
For recent gap ups, they could set up a good short sell. What are the nuances that might make you go for one stock versus the other, like market cap size, the size of the prior move, the character of the stock? What are those little details that might separate B+ setup from a triple plus setup for you?
So market cap is one. You want to see how thinly traded is it. How low is that float, and liquidity is another one. If you're going to take on position size, I want to make sure something that is highly liquid that I can get out, get in, and more importantly, I can get out if I need to. Last thing I want to do is short something really illiquid where one uptick can halt the stock and you're halted. You don't want to mess with that at all. So liquidity is number 2, and then really just the extension of the move. How extended is something? What is the risk reward on this setup? So yeah, that's great. And then fourth, like I said, 10% is fundamental analysis. I'll dig a little deeper into the move. Like, why is it happening? What are the financials of the company? Do they need to get raise money or do financing? To try to put together, my overall thesis. And then again, looking at the chart, looking at the historical move of the chart, did this move have something similar in the last 6 months or 1 year or 3 years or 5 years? And,
story.
Those are probably the main categories, but I would say, volume, liquidity, the float, and the extension of the move. The extension of the move really tells me my risk reward potential on it.
For float, I assume lower is what you prefer. Do you have kind of a rule of thumb number that you kind of look for?
Lower is not something I prefer, because again, the lower the float is, the more volatile you're going to have. So as the small cap trader, sometimes you might look at a stock with 1 million share float or 2 million share float. I don't even trade those anymore at all. I don't mess with those whatsoever. They're too thin. They're too manipulated. So I would like to have something with at least 5-10 million shares traded, at a minimum, to make sure that there's, ample liquidity to get in and get out of positions that you need to do.
Yeah, and in a similar vein, so what average dollar volume or average just shares traded on a day are you typically looking for to make sure that you're not going to be stuck in a position that goes against you? Do you want to be a certain percentage of the average? Yeah.
No, that's a good question. Again, it's all that's going to help determine your position size. I mean, I've had small caps that are trading 1 billion shares in a day because they're, the algos followed them and the momentum followed them, and that's the hot stock of the day. And yeah, you can trade ample position size there because you can get in or out. If something's only trading, 5 million shares of a day, that's very, very thin. And there's just no way you're going to put on the position size with that stock because that, there's big potential, risk of, being stuck and not being able to exit when you need to exit.
Think you know where ball's gonna go? Test your theories with backtesting. Pick from hundreds of symbols, any strategy you want, and all the data.
Some people do that.
Talking about the 10% that's fundamentals, you talked about diving into why is it moving. Are there catalysts that you found are really good, catalysts that eventually become good shorts? Like, is there a situation that you love to see that okay, this move is driven by X, this is likely going to be a high potential trade for me?
Yeah, and that comes with being familiar of reading press releases of small caps to know when you decipher the actual, legitimate press release versus the BS. And here's a good example. So back in COVID, what was every biotech company trying to do in, like March, April, May, June, July of 2020? Everybody's trying to create a vaccine. So all these small cap companies were putting out press releases. We are trying to create a COVID vaccine. And you can go through the history of where they tried to cure, Ebola and failed, and they tried to cure the bird flu and failed, and they tried to even maybe create a flu vaccine, and they can't do that. You're like, okay, this company has 4 employees, they have no cash, they have a history of putting out press releases that they're trying to cure numerous common diseases, and they haven't been able to do any of that. So the likelihood of them being able to cure COVID is literally zero.
Okay.
So that's where my fundamental analysis comes into play. Like, this is bullshit. The fundamentals are garbage. But again, the technicals, that's why I had 90% technicals, is that we've seen fundamentally crappy companies just run up to highs that nobody thought was possible. I mean, GameStop is a great example. I mean, there's no fundamentals, but you got to trade the chart. You've got to trade the trend. So I want to keep, that 10% of fundamentals in my head, knowing, okay, this is the situation. And then it goes into strictly reading the chart, trading the trend, and going from there.
Yeah, we have a saying in our style: we buy based on fundamentals and technicals, but we sell only on technicals, or we manage the trade only on technicals. And if the technicals don't match your thesis, that means the thesis isn't applicable right now, even if it ends up eventually being true.
Right. Absolutely.
Cool. One question I had for you, and this is a question a lot of people had, is what issues have you run into with the short sell strategy when it comes to scaling your portfolio and trading a bigger account? Yep. Are there limitations you've had to adapt your style a little bit? And how have you kind of
just play some Bloomberg here?
Kind of like a latex type of piece, molded it, cast it, and then blew that up in scale and put it into a clay, and eventually had that transformed into stainless steel.
So when you have a balloon dog, let's say, a regular size one or then a big one, did people say, Jeff, you're crazy? Were you shocked that people were willing to pay very high prices for this?
When I was making my first balloon dog, one of the purchasers was Eli Bro. And originally I thought I could make a balloon dog for around $300,000 that I could manufacture. It's a large piece, over 10 feet long, or 12 feet long, 10 feet high. But it turned out that the fabricator came back to me and said, Jeff, I can't do it for $300,000. It's going to be $650,000. But eventually, then they raised the price again, and they finally brought it up to $1.6 million. And I told Eli that this is the reality of it. I showed him everything, and he ended up paying for the production costs.
Bringing you
you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bloomberg Tech is live from the heart of Silicon Valley with Ed Ludlow in San Francisco.
Let's go back to what we're doing here.
This is Bloomberg Tech. Coming up, Meta agrees to settle.
You need to find new edges as your account has grown, and you're not able to because obviously we've talked about liquidity being an issue, the float being an issue. So what adaptations have you had to make as your portfolio has grown?
Yeah, so that's the hardest thing with short selling and short selling small caps is the liquidity and the ability, the inability to almost scale. So again, I have kind of adapted a little bit more the last several years to an option trader and an option seller because I can scale that and a little bit less on the short selling side. And the issues that I've run into are just that. I mean, you can only grow so much when you're betting on cheap stocks to go down, right? I mean, they can't go below zero. So, what percentage gain can you make on these? So
Pretty interesting, actually. Selling options versus shorting these companies. Although, yeah, pretty interesting with the leverage aspect.
the other thing that has kind of thrown up a red flag are some of the wild, crazy moves that we've
Particularly with the, I guess the acquisition problem would get worse. I'm gonna have to pencil that out.
seen some of the last few years, and especially some of these, cheap Chinese scams, almost stocks that could run from $100 to $1,000 even after hours. I mean, and some of these things. So liquidity is huge, and something that was tougher several years ago, it's gotten easier now, is the borrows. I mean, you have to understand, if you were shorting a stock, you have to have a borrow. You have to find a locate, and that's not easy to do. And some brokers have great locates, other brokers don't have any locates. I mean, other than on large mega cap, thickly traded stocks. So you have to have a locate. But I think, I mean, scaling is something that's almost impossible to do. I mean, you can't. You can only get so big when your strategy is to just short small caps, and that's it, right? I mean, there's a limit to what you can make because, again, you have to watch your risk. You have to watch the other side. I mean, you can't just go all in on everything, because when you need to exit, there is no exit sometimes with thinly traded names. The examples I gave, the MicroStrategy Super Microcomputer, the reason those are really A+ for me today is because they're thickly traded, higher price, major volume, major liquidity. Take any position size you want. You can get out in a second if you need to. So with the smaller caps, that's just not the same size. So you can get out in a second if you need to. So with the smaller caps, that's just not the same size. So my hope is, I'd love to see more of these, moves in the higher price stocks for sure, just because they're is easier, they're safer, and yes, you can make. I would never say unlimited money in these, but you can make the upside is so much bigger on some of these large cap stocks than it is on small caps.
And, it sounds like also you've kind of looked to develop more edges or more strategies. For instance, you mentioned, selling options for income. That's one thing you've tried. I know, I think in previous interviews that I've watched you have been in,
maybe just selling options, we'll call it.
Trying a little bit more to the long side, momentum, swing trading a little bit. So, could you talk a little bit more about the the option strategy. Obviously, this is more advanced. There's stuff you have to consider, but I'd love to hear a little bit more about that as well.
Yeah, so I started trading options almost 10 years ago, and I instantly was kind of hooked selling options. It's not something I talk about a whole lot because it's very dangerous. I mean, it's a dangerous method, and I sell a lot of naked options. I do some spreads, I do some covers, but for the most part, I'm selling naked options way out of the money on 50 or 60 different names. Basically, I want to sell puts on stocks that have big relative strength, in a good uptrending market, right? That's kind of the overall strategy. I want to sell puts.
That's interesting. He's selling puts. I thought he was going to say calls. Maybe I want to say that.
On strong, good, profitable companies in a bull market, and we've been lucky enough to have a bull market for quite a while now. Again, when does that end? When does that change? I don't know. But the options, it's definitely it's a highly advanced strategy. It's not something I recommend. It's not something I talk about at all. I do discuss a little bit, in the Market Wizards book that comes out in June, but it's definitely not for somebody new to trading whatsoever. As far as the long side, I've been kind of trying to adapt for years. I don't have any problem finding momentum stocks, right? I mean, we can pull up a screener, we can see what's being bought, we can see the strong companies with good fundamentals in a good industry. The hard part for me is saying, hey, I want to hold this 60 days or 90 days, and I have a hard time holding it past a few days because I have that kind of day trade mentality. It's just I'm used to taking profits quickly. So when I see profits get away from me, or if I see what I think is the trend turning or the tide turning, I sell way too fast, only to have it continue its uptrend a couple days later. So it's definitely a flaw in my trading I'm trying to learn. But again, I think it's good to adapt as a trader and try to change and try to learn new methods, which is, what I do, or have done. It's just like we talked about before, you gotta limit your position sizing on that stuff.
Yeah. Excellent. Phil, this has been great. I just have a few quick wrap-up questions.
Sure.
First, this is, again, one of my favorite questions to ask, and I think your perspective as someone who trades options, short sells, this would be really interesting. If you had to explain what managing risk means to someone who has never traded anything like that, what would you say? Basically, how would you define what risk is in the markets, and how do you define that for yourself, and how do you manage it as well as a trader? Because that's really our job.
I think your risk is your capital that you're willing to put up, whatever that amount is. For me, it was $3,000 in college. Now, I was willing to risk that. I didn't lose it overnight. I slowly lost it over like 12 months, but
it's hard to see,
because I knew the potential upside. So your risk is at any given time the capital and the amount that you're willing to part ways with. And it's parting ways with your capital is one thing, but again, it's how you can handle that mentally, and that's how I think so many traders differ. Some active day traders can have massive swings in their account, 30%, 40%. And they can come back the next day and be like, fine, no big deal. I'm going to, for me, I just, I cut my losses immediately fast, 5%, 10% max, and that's it. And, trading, one of the hardest concepts I think for traders to realize, and I've traded 20 years, and is that how hard it is mentally, and how much the mental side of trading really comes into play. We can all look at trends, and we can all look at A+ setups, and we can all say, I
think that's probably going to do it. That so far.
Some of the concerns, but again, there's only so much they can do other than help kind of finance and facilitate the build out of these, but they're not the ones actually building them. So again, that comes down to the hyperscale.
Went through a terrible strike and really compromised the amount and the variety of product that was in the theaters, and now it's back. There's great product, and I think the thing that's really encouraging about it is that young people are going back to the movies.
Don't miss The Close live every weekday.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Lisa Abramowitz in Rio de Janeiro, and this is Bloomberg.
Meta has agreed to settle a landmark teen social media case. The company says it will pay up to $18 billion over 10 years and impose new restrictions on young users, including nighttime blocks and daily use limits for under 18s, as well as using stronger age verification tools. The Facebook and Instagram parent was sued by 29 state attorneys general for alleged violations of consumer protection and privacy laws, allegations the company denies even in the court settlement filing. One of those that sued, West Virginia Attorney General J.B. McCuskey, joins us now. Attorney General McCuskey, thank you for your time. Please just start with your general reaction to the settlement and what you think it indicates.
Yeah, so I think the first thing that needs to be mentioned is that this is a bipartisan settlement. And we see so frequently in Washington how politics gets in the way of leaders taking bold actions to protect Americans and to do what is right for their constituents and the people. And so a huge thank you from the people of West Virginia. We worked a lot on this case, but the AGs, the Republican AGs in Tennessee and Kentucky, along with the Democrat AGs in California and Colorado, really led the way on this. And so it really is kind of a remarkable little window into how bipartisan politics can work. And I think your intro in terms of how the settlement broke down is incredible. I mean, this is a $17 billion global settlement that will be paid out over about 10 years, as you said.
Yes.
But I think most importantly, and West Virginia is going to utilize the roughly $115 million share that we will receive from that to very, very good use to make sure that our children and parents have everything that they need in what is a very trying time to be a parent. I am one. But the injunctive relief is really what is so remarkable here. And what you're seeing is that these tech companies are recognizing that their products can and are dangerous to children, and that they need to be doing more to be cognizant of that, to admit that, and that they have the tools to make it better. And we're really, really excited about what the future looks like for children in this country who use social media platforms, which is basically all of them, and what this lawsuit's going to do to make their lives a little bit easier.
Attorney General McCuskey, if we can just continue with the financial settlement for a moment, there is a discrepancy. The court filing says you agreed to a near $17 billion settlement. Meta is saying up to $18 billion. My understanding is that there may have been a separate or ad hoc settlement with another state, Texas. Could you shed any light on that?
So I don't actually know much about the Texas settlement. The numbers there add up. I know the AG in Texas very well. He's a really great guy, and I'm sure that he did the best he could for the people in Texas. I'm sure their settlement is incredible. And if the numbers are 17.1 and 18.1, it would make enormous amounts of sense for that $1 billion going to Texas to have been added to the number in the press release.
Thank you. I appreciate that. Did you achieve what you wanted to through settling that you would otherwise have targeted through the court system?
Yes, and I think that you can't really separate those two things. So we did achieve this through the court system. And so what we achieved occurred because we were able to put sufficient pressure on Meta during the trial process, right? So it's important to remember that this happens sort of shortly after they presented their case. And so, what they understood was that they were in a really bad position if this case went to a jury. And so just because a judge didn't make this decision or a jury didn't make this decision doesn't mean it isn't a result of the incredible work of the staffs of those four attorneys general. And interestingly enough, all the staffs of all the signatory states, right? So my team works every single day with the teams in California and Tennessee and Kentucky and California and Rhode Island and Louisiana, you name it, right? So that our staffs are all very, very close and work together on a lot of these issues. So, this is a result of the court process and would not have happened but for the fact that we were winning this lawsuit and Meta knew it.
We're live on Bloomberg Television and on Bloomberg Radio. This is Bloomberg Tech speaking to West Virginia Attorney General J.B. McCuskey. A part of the $16.7 billion settlement, $5 billion approximately, is held back by Meta, contingent on TikTok and YouTube adopting the same framework that they have agreed to. And we can get into the specifics of the framework. At this early stage, have you any indication of TikTok and YouTube's conditions and attitude towards following that framework?
So I haven't had any direct conversations with either of those two companies. I would imagine that there is a litany of litigation coming against them in the coming months and years to make sure that that part of this settlement is accomplished, right? And I think it's really a novel approach. And to the folks that came up with this idea on how to sort of link these two things, what's important about that is that kids use all three of these platforms. And we believe that the injunctive relief, the things that you talked about, the nighttime caps and the hourly breaks and the 15-minute break every hour, these are really important things. And so what we want to make sure is that these other groups, these smaller companies, are implementing those same two things. So it actually gives us incentive to make sure that our children are being protected in the same ways on those platforms as they are on Meta. And it gives Meta the incentive to make sure that their competitors are also following the same guidelines that we placed in their lap with this settlement. And so it really is sort of a master class in how to settle a lawsuit and how to make sure that both sides have skin in the game.
My understanding is that TikTok, as a case study, faces, I think, around 15 different AG cases that are not consolidated. And YouTube and Snap, for what it's worth, I think face a smaller number than that.
Even just yesterday, Snap was sued by the great Attorney General in Pennsylvania, Dave Sunday. So, like I said before, I believe these cases are coming.
So how does that fit in, and how aggressive will this coalition of states be in saying, we've done this with Meta, we want you to follow suit in this framework that Meta's agreed to adopt?
Yeah, I would say very aggressive. I think what we see here is the success that we've had in this Meta case is a blueprint for how to be successful with other similarly situated tech companies, because the harm happening to children is the same, and it's for the exact same reasons. And so it has always been our goal to make sure that every platform protects children in the same way that Meta is going to be protecting children based upon their willingness to change their platform based on the pressure that we placed on them in this litigation.
I want to go into some of the specifics here. So the mainstay of it are limits on the use of the two platforms, Instagram and Facebook, by 13 to 17-year-olds. And in one example, there is a 2-hour daily limit where a teen can't simply exceed that. It would require parental permission, essentially, for a teen within that age bracket to use the platforms for more than 2 hours. How sort of contingent is the success of this initiative on the parents buying in to what Meta's agreed to do?
Yeah, I think very contingent.
Consolidate
and I
here
think
because
in this
it does
country,
look to us like
one of the things that is paramount
the
is
move
that
that we've
parents
had recently
do
broke the
and
back of
always
the bear
will
market
have,
that's
the
been
best
in place
interest.
here for about 6 or 7 months, and I think it's starting to set up more bullishly now.
Industrials losing relative performance leadership. Is that bad news, or is it a reflection of what maybe healthcare and financials have done, or something else?
Well, it's a little of everything, Carl, and it's a great question because, industrials have kind of been infected with the AI trade, right? Caterpillar and turbines and everything else. And so I think you're getting a little bit of that knock-on effect. You're seeing it in electrical equipment. You're seeing it in the construction and engineering, but you're seeing it in cap goods. And so you're not seeing it in transports, which is good news. But I do think that there is a decline in the relative performance, and it's worth noting because they were, they don't get as much press on this, but they were every bit as part of the momentum trade as tech was and semiconductors were. So I think you're seeing that kind of play itself out. I think the move is moving away from, let's call it cyclicality, towards things that are more defensive, like healthcare, a little bit like banks. But healthcare looks great to us, and I think there's a long road ahead for healthcare.
It's been a few days since Besson came on our air. Certainly the announcement by Treasury and all the memes and Besson bringing water guns into firefights. Are you in the camp that you don't declare war with the market with a finite amount of resources, or can he set a marker on the long bond at least at 5.3?
I think it's both. I think you can set a marker, but I think in the long run, and trust me, Secretary Bessent knows this as well as anybody. It's very hard to out-policy the market, and there is the adage of a bazooka. I just don't know that.
Okay. Let's do a little. Little conversation here. So, yeah. Yeah, I think you're going to go to AI mode here for a second. So, selling options in the case of acquisition. That's pretty much what I want to say. Selling call options. Give recent examples. And minimum account size, interactive brokers to sell naked options. Okay, let's see. Netflix's acquisition of Warner Brothers. I don't know if Wiz is a public company. Well, I guess you just need $2 grand. Give expected loss for 30K account, shorting Warner Brothers for acquisition. Okay. So let's see here. Yeah, the debt part's unfortunate. Let's see. 15 eventually climbed. Basically it doubled. From 22 to 28. This was December of 2025. Okay. Okay. Yeah. Took a few days though. See this chart I'm looking at here. It took a few days right in the middle of that chart. And it also looked like the stock was moving up prior. But still, let's see what else is going on here. Aggressive out of the money. Auto liquidation. Yeah. We'll just buy it. So if you sold calls on December 22nd, for example, on that 30K account, what would have been a loss. Let's say you sold whatever 28 strike price and held it 29 for a few days, right? $29 strike price calls and held for a few days. 22nd or whatever, I guess the December 4th. And then 5th, and then so 4th was a Thursday. So for the following Friday. So it happened on a Thursday. Yeah. Sold 19 strike price calls. Nope, buddy. 28 strike price calls. The stock was already at 22. So you were selling out of the money calls. That's what we're talking about. You sold naked calls. The loss would be 0, but you would be liquidated for a substantial loss on Friday morning anyway. December 4th. So the 4th is a Thursday. 28 call expiring the following Friday. Would sell for roughly 25 per contract. IBK grabbed 450 contracts. You could sell 66 of those. Execution because the stock closed early, the option expires. Because the stock closed right at 28. Wait. Yeah, that was a bad example. What if you sold $27 calls for that expiration? Okay. Okay. So this is, yes, your stop loss was too tight. You probably automatically liquidated. Yeah, so that's the wrinkle. Yeah, is you sell them for 40 cents, they go to 75.25. Net margin goes to 760. So you need more. So you'd lose like 10 grand. Okay. Do you not have 2x margin? Are you sure it would liquidate? Right? So you have 30, you should be able to. Does give you, even if they would still liquidate it versus maintenance margin. So you use your 30K to buy the, whatever, sell the contracts. Leverage doesn't protect you from the maintenance. So yeah, it's not really 2x, I guess. Your kind equity is going to pass with other 2x because you're shorting options, all scales exponentially. Okay. Option per diem exploded from 40 cents to $2. Your floating loss on those contracts is instant. Your new equity. Calculate IBKR's real-time maintenance margin requirements. Recalculates the collateral required. Oh, this is from. How do you know the option prices at that time? I'm a little skeptical, like, 'cause sometimes these AIs have trouble. No, literally, do you have the data? Like, they have market, opens and close, and they're estimating. Yeah, so they don't have them, but whatever, it's fine. Okay, if I give you a list of trades, can you tell me what I would have made selling options instead of shorting? Give it a go here. So there are the trades. And then basically put the win rates in. Okay. So here's the list of trades. Here's the list of trades. Here's the gain, loss in dollars. Okay, this is pretty ugly, the information I'm giving here. So the losses are shorts that stopped out. Convert those shorts into sold options and recalculate gains and losses. It would be better if I gave you how many shares I had, but do best. I guess I could do how many shares. Let's see. Just trying to log in, brother. Let's see. 1 month. Where are we at here? Trades. Okay. So let's see this. Yeah. Should be able to calculate based off of this. Should be able to calculate position side of this based off these screenshots. Okay, so there's one. And then we'll do another. Yeah. P to ETN, something like that. Okay, so there's another. Okay. And then target to TPR. There's some more. Could be interesting to see what the TPR loss is. And then Airbnb to the second RTX. Okay. Let's see. Note the starting account size of, say, 29,000. Okay. It's quite a lot of information. So, I don't think that loss. Oh boy. Difficult position ranges from blah 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 blah. Loser cushion because option premiums expand. I don't know what losers or cushion means. Yeah, so modeled short call. You know, somehow it's less. What is the premium ceiling? I thought I would have more. Modeled conservatively at 2% of position size. I don't understand why that's capped. Somehow the loss is capped too, though, interestingly. In this. Why are they capped at that amount? Shouldn't selling the options give me more leverage, aka allow me to take larger position size and have greater magnitude outcomes, right? When you short a stock, your profit increases. Literally, for every dollar the stock drops. Stock drops 10%, you make 10%. Yeah, that's how I understand it to be. When you sell the call option, you get premium exchange for the right to buy the stock. If it becomes worthless, you get to keep the premium. Yeah. You never make a single point on the premium. Okay. Maximum gain potential is limited. Oh, I see. Because I'm selling options on ones that I think will go down versus ones that I'm not sure about. In other words, people feel more strongly bullish of them. I don't know. If you took you wouldn't just you'd use the reduced function. Maximum options. You sell ATM calls, collect 2% premium up front, the stock drops. The outcome, okay. By leveraging your account size up to control more contracts, you successfully doubled your dollar return compared to the stock short. Few the options found MDP wins in your trade line. No, that's not those went down. Leverage differences. before we get to bare credit spreads or whatever you were talking about, rerun the calculation for the actual position that I would be able to take given the numbers I gave you. Obviously, I took basically max leverage short positions, basically. But why didn't you assume max leverage short call positions? Right? A conservative assumption. Yeah. That's what I'm trying to do. That's what I expected. Okay. Scaled loss due to high size. This is what I want to understand, why that is not such a bad loss. I guess they doesn't look great, does it? Oh yeah, no, it is better. Drawdown. Yeah. Ooh, wow. That's pretty. That's a lot. Hmm. Hmm. Okay. And why was the TPR loss size it was when selling the options? Is it because TPR didn't go up a ton like an acquisition? Was a worse loss. It's my worst loss. Shorting stock. Why would it not be so bad shorting call options? Oh, it only moved 3% up. Oh, so I still collect. An acquisition trade is now deeply in the money. It still violently accelerates, meaning you now inherit 100% of the maximum damage with no way to exit early. Before we get to bare call credit spread, let's run the numbers again. Let's say I'm using half of the leverage allowed by IBKR. per position and selling option. And let's also throw in, let's say instead of a 3% loss on TPR or whatever, aka instead of assuming I sold out of the money calls on TPR and TPR price went above strike price, aka I got liquidated on TPR. Let's assume TPR got acquired for 30% higher price than current price. What would have been path dependence, aka what I'm really asking, what would have happened in this aggregate scenario day by day? But I don't even know if it would make it to the end of the whole sequence I gave it. So things are good, right? You make a little money, make a little bit more money, make a little bit more money, make a little bit more money. Things are good. Then TPR gets acquired. Well, that would be bad. But not crushed, interestingly. Okay. Slice. Here's your algorithm. Slash your available number. So maintain a 75 by half. Interesting. So I have a couple losses. So this one was over the expiration, or above the strike by expiration. Blah, 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 blah. Kind of just chop it around down here. And then make a little bit back. Wow. Okay. Let's assume the following month I continued the strategy and use the same example trades, you know, starting with where I ended the first month, which was like 18K, but continue. Yeah. Assume TPR was a 3% loss, not an acquisition in this second month. Go. Okay. Does the liquidation algorithm allow me? So now I'm basically back to where I started. Okay. Do another month like that. Where would I be there? That would bring me out to 44. Do another month like that. So this would be 1, 2, 3, 4 months. Okay. So after 4 months, I'd be up at 69. Okay. So I'd be up at 69K after 4 months. what about if I had been shorting stock that whole time? So assume the second month, first month has the TPR acquisition, like we did for the short calls, and then assume the next 3 months have the 3% TPR loss. All right, so let's compare that. Okay. Month one is down, the acquisition, but maybe not quite as down as the option ones. 2, 3, 4. Yeah. Selling the options definitely seems better. You can stomach it. Okay, now repeat 4-month test, but doing bear credit spread or whatever you are trying to convince me of. Remembering IBKR margin. Okay. Let's say that. You sell the call and buy a call. Before trades expire. It's fine. That's the acquisition. Oh, but my net loss is capped. 5% of 80. See, that's what I want. An actual stop loss, but with more leverage. Okay. You enter month 2 with that amount. Since your balance grew, your discipline position layout safely ticks up. Month 3, month 4. Okay. Bear call spread. When TPR got acquired in month 1, the make it options and stock short strategies suffered massive structural damage. Credit spread. Sure, whatever. Go nuts. Do your thing. Because this is kind of what I'm doing. Yeah. Go nuts. Do it. When you shorted stock or sold naked calls. So a naked call. Okay, no, I don't want to do the actual thing. What are the downfalls of this approach? Must be some downfalls. Efficiencies. Yes, you do need a positive win rate. It's fine. Yeah, that's what I'm worried about. I don't know how bad that is, 10 cents a share. The option contract will not immediately drop to zero. Options will still retain time value. Traders will still be willing to pay for them. You're forced to sit on your hands and hold the position to close. That's interesting. Yeah, that's a problem. That's a problem. You hold a credit spread all the way into Friday, you run into one of the most dangerous structural mechanics pin risk. Your short strike is 40 and the stock is trading at 40. A little bit more. So you wake up Saturday morning holding a massive raw negative short position with zero protection over the weekend. I don't really get that. I don't get why you don't have protection over the weekend, aka pin risk. That doesn't make sense to me. Yeah, I don't want to say you're lazy. Buy to close your short call and sell to close your long call. I don't think that's a problem. So basically, you can't do short calls over the weekend? What if your expiration is the following Friday? Your option expiration is the following Friday. You are one of your options expires this Friday and one expires next Friday. Is the problem. Something like that. I don't know. No, that setup describes a completely different day of trading. If they both expire the same Friday, what is the pin thing? Doesn't make any sense. But I still don't like that you have to like wait and hold it for like 5 days if you short on Monday. It stands directly between your two strike prices. You sold this Yo shares, it's at 40, you bought this. Okay. The stock pins at 40.50. Cool. They just exercise it. They I think that's what he's saying. Is this thing not listening anymore? Fuck, this thing is not taking my input. But if they get assigned the shares or whatever, who cares, right? I already did premium. Now I have to give them the shares. Can't I just immediately cover the shares before 8 p.m. on Friday? Yeah. That could be ugly. Oh, weird. So why not just always close before expiration, even if it means I don't collect full premium? The decay is not a straight line. Yeah. Yes, I've already got most of the money. So considering it takes a couple days for my short stock positions to go down, considering I get the vast majority of the premium in a couple days, usually in this bear call spread thing, and considering something else, sometimes what's happening is I'm shorting stock and it just goes sideways for like 4 to 5 days, and I'm not stopped out, but I'm also not in profit, and those short stock positions are taking up like a third to a half of my buying power, considering I can only use 2x leverage on IB or slightly less to have a errant position cushion, we'll just call it, aka a short position moves up slightly before close. So I have 1.7 leverage on, and by end of day it becomes 2. Anyway, considering all that, you're saying the bear credit spread is a more apt strategy for comfortable profits than this multi-day short strategy I'm currently employing. That's what we're asking. Let's see. Where's the this thing's scrolling. I've just discovered what you tried to tell me like an hour ago. Blah 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 blah. Fuck, dude. I just wrote all that fucking shit and it just doesn't even show it. What the fuck? Where is the but I just wrote out a huge fucking question. You just aren't showing. Where's the fuck you. Fuck you. I'm asking, considering the short stock strategy I'm doing, where I hold for a few days to maybe a week because fucking shit goes sideways sometimes, doesn't stop me out nor goes down to my profit target. You're fucking saying the bear credit spread is the move. It will lead to making shitloads more money with equivalent risk, pretty much, versus shorting, the way I'm doing it now. And considering the margin requirements. So, for example, right now I have like, let's say 3 positions on at a time, each in aggregate making up 2x of my 30K. So, yeah, explain. I'll copy it. Good. When you short stock, time is your enemy. Yeah, this is what I'm experiencing. When you sell a bear credit spread, time is your best friend. Okay, that sounds good. I get the money. I make the money if the stock goes down. And you make full profit if the stock goes up. Yeah, that's good. If the stock goes sideways for 5 days, because it's choppy, the option premium you sold naturally goes to 0. You can often close the stock for 50 to 70% profit without, and this is important, the stock ever going down. You turn dead money into a winning trade. There's expansion. You lose 6,000 instantly. Okay. You sell, they have to make call and buy a protective call 5 minutes very soon. Because credit spreads doesn't require a 50% margin, they only require you to cover the width of the spread minus the premium collected. Wow. To match your current 20,000 only blocks 700 margin. Total margin locked by IBKR is only 2,100. Out of your 30 account, you only use 2,100 of majority of 27.9. You're miles away from you make sure because spreads require so little margin collateral on IBKR. You have 2 choices to scale your income. Keep the same position size to keep the exact same risk footprint. Your winning position shoots in front because the sideways trades now close the winners. Your losing trades are heavily cushioned by the options delta, meaning your average stop loss costs you far less cash than a short trade. And you make more money purely through higher win rate and smaller losses. Choice B, safely scale up your position size. Because you have that cash sitting there, you don't have to limit yourself to 20,000. Just up to 50,000. Just scale position. 3 positions. 50x notional because 150 total margin locked by the is still only 52.50. You still have that buffer. If you harvest a 1.5% net premium on a $50,000 layout, you pocket that up front. When a stock goes sideways, you clean sweep 22.50 because that's 750 times 3. Cross you 3 positions. Okay. Current stock chart forces you to take maximum account risk just to get linear returns. They completely fail. What are the downsides of this strategy compared to the short stock strategy I'm currently employing? Let's see it. Let's do that. Oh, didn't do it. What are the downsides of this strategy compared to the short stock strategy I'm currently employing? Okay. That's what we want to do. Well, the credit spread strategy sounds like a no-brainer. It does have 3 massive downsides. These are used to the strategy measures. The biggest adjustment you'll face is the credit when you cut off your ability to catch a massive order. That's fine. If you short a stock at 4, class is 50%. Massively, about 3,000 on 20K position. So I'm not really doing that anyway. If you sell a bear call spread and the stock collapses 15%, your profit is hard capped on day 1. If you sell a bear call spread and the stock collapses 15%, your profit is hard capped on day 1. Let's check in with this options guy. Okay. So if you collected, so if you sell a bear call spread and the stock collapses 15%, if you collect it, that's the stock could go bankrupt to 0 and you have time to get trapped. Yeah, this is the thing that matches the stock price instantly. You short stock, your profit matches the stock price instantly. The stock drops your target, or as you close it to your crash. The credit spread options pricing is anchored by time remaining till expiration. Yeah, this one could be a problem. Here's the problem. If you sell a 7-day spread and the stock immediately drops 3% on Monday morning, yeah. The option counters will not instantly drop to 0 because those still did what market keeps pricing exchange value. Your screen might only show a temporary $50 profit when you the stock. You're forced to sit on your hands and wait for days to let time decay tick away. Yeah. That's one thing. And then this is another thing. Wide bid-ask spreads and slippage. Shorting highly liquid stocks and cheap really switch your exchange looks like. Credit spread bars are too late action or selling much of option contracts to the trade volume. The gap between what buyers want to pay and what sellers want to take can be wide. When you try to enter exit a 3-position spread setup, you have to cross that bid-ask spread twice per trade. If the options are thinly traded, you'll suffer slippage of a few cents per share. Just to get a few cents is fine if that's actually what we're talking. Slippage acts as a friction cost that directly eats into your net returns. Problem that doesn't exist when you short the underlying stock cleanly. Yeah. Instant uncapped profit potential if your current structure for a slower cap process that rewards you living rates. Okay. 3 days or 7 days. Well, I'm already only pocketing 3% gains on these short opportunities. But the spread costs are what concern me slightly. Give estimated fees for that. I include in the monthly calculation you did. Also, do something else that I forgot. Oh yeah, I'm hesitant because sometimes the stocks bounce back up. So like, they may go down 3% the next day, but bounce back up by Friday. So I still need a win rate that is over 50%. Yeah. Since IBKR charges commissions per contract leg and options students, standard pricing, 2 cents per share. Credit spread still beats pure shorting by stock shorting by 41.4. Slippage. The bounce back problem. Yeah. Because your profit target on the island tag is already a 3%. You use the same tactics. The value of that short put option will plummet instantly. You do not have to wait until Friday. I don't think I'm selling at the money spreads though. Right? The moment the stock hits your 3% downward target, your option spread will show a 60 to 80% profit realization. $60 to 80% profit realization, which is pretty good. What if it bounces before you click cover? So yeah, it's going to get interesting, but I'm sort of making it up for it with the ones that don't hit my profit target, but don't hit my stop either. Yeah, the 65% profit is interesting. It's kind of like the take profit target order, good to cancel order I have with the short bracket orders I'm doing already. One thing is you mentioned these are at the money bear credit spreads. I was more thinking of mimicking the strat I am doing with short stock by doing not at the money ones, not at the money, more like if the stock goes up 4%, 3%, my long call texts me and Yeah. My short call is 3% up, I guess. I don't know. Maybe this whole bear spread is meaning by definition at the money for the short call. Wasn't really paying attention to that part. Out of the money one. So if this stock is trading at $100, yeah. If the stock is trading $100, and your strategy dictates that you want to short it, gotta eat some food at some point. You want your stop loss to be 103. We're going to eat a little food and then come back to this.
All right, let's talk about this landmark deal today in the wealth management space. Vanguard is buying a wealth management platform, Altruist, for $4 billion. What is Altruist? Well, it's a wealth management platform founded in 2018, basically an upstart that was intent on challenging Schwab, Fidelity, and others. So now you have the world's second biggest investment firm wanting to expand its reach into that area, into financial advice, which is a relatively new area for Vanguard itself. Josh Brown joins us now on the phone. He's an advisor and shareholder in Altruist. It's notable that if we take a look, Josh, at Schwab, Raymond James, they're red. They're red because of this deal, more than likely, which you say is going to rock this industry. Guys, I'd like to see those stocks, please, if we could. So give me more information on why you think, Josh, this deal is so important.
So thanks, Scott. You and I sat with Jason Wenk at Future Proof this past March in Miami, and we talked about just the idea of AI and a tech-native brokerage custodian all of a sudden coming in and disrupting the realm of wealth management. And what this does is it basically puts, as you said, the second largest asset manager on earth and its resources behind Altruist and their AI solution, which is native to the platform, called Hazel. And I think it's an earthquake because, for the most part, Altruist is thought of as a venture-backed startup. And a lot of wealth managers with billions and billions of dollars are hesitant to trust a new platform or a neo-custodian with their clients' money. All of those questions about the brand, about the provenance, those all go away. Now it is a wholly owned subsidiary of Vanguard, but with the cutting-edge technology of a startup. So that's why this has the potential to shake up the industry, and I'm super excited about it personally.
We do have ownership on the desk. Stay with me, Josh, because I really do want to hear from others. So, Carrie, you own Schwab.
Yeah.
This seems to be the one that the market's most fixated on today.
Well, if we look at the competition, and the two competitors would be Schwab and Fidelity in this business. And let's not dismiss them as unexperienced and ineffective in fighting competition. So they'll see this. They have a great deal of technology behind them. Schwab is been gaining market share. They've made acquisitions that have been extremely accretive. I don't doubt that they're going to continue to fight this well. They offer wide platforms to all types of asset groups coming in, from people who are starting with $1,000 to the most sophisticated RIAs, and that's true also of Fidelity. So I think it's great for Vanguard. Vanguard, as we know, sells index funds. They've not given advice. They're going to have to change their image. They're going to have to spend a lot of time to integrate
Well, the new
this.
leader of that business, Vanguard's business, made it clear when he took the job that was the next and new frontier for Vanguard.
Had to be.
And now
because,
they make their offensive, if you want to continue that analogy there. What do you? So
Sorry, guys, I had to
Schwab
get
and
some.
Ray J. So give me that first, and then I know you want to ask Josh something, but give me that first.
This is problematic. It's problematic for these giants like Fidelity, like Schwab. But I think an interesting angle to take here, and the question I have for Josh. Josh, first of all, congratulations for being a shareholder. But what do you think the message is here for a traditional wirehouse? Let's take a look as you're answering to Morgan Stanley today, which I'm sure is down off of this news.
But anyway,
Thanks, Joe. And you'll have to speak up. I'm on the phone from a Rolls-Royce dealership. So,
yeah, the nice. Dinner's on you, dude.
Carrie is right that Schwab and Fidelity have fought off
on the
plenty of competitors. And full disclosure,
Rolls-Royce
my firm
dealership.
custodies client assets at Fidelity, Schwab, and Altruist. So all of those platforms are incredibly powerful. They all have, technology and solutions. And I don't think it's a winner-take-all business. But what I will say is this.
Okay.
I think we're one of the fastest-growing firms in America, even given our size. And the amount of onboarding we do of new customers on a weekly, monthly, quarterly basis, I think gives me the authority to say digital-first onboarding tools are the holy grail for the wealth management industry. The ability to send a link and have a client download the Altruist app and onboard themselves supercharges fast-growing firms like mine, and there are others, and now the resources of Vanguard behind that, they could go from 500 engineers to 2,000 engineers overnight. So we feel very strongly that the wealth management firm of the modern era is multi-custodial, and that all of the major custodians have things to offer. But this is now a third entrant with some really deep pockets. And by the way, Jason Wenk is staying. This is one of the most important things. He signed a multi-year deal to stick around. The team is not moving from California to Pennsylvania. They're going to stay put. The engineers who built this platform. And I think now you're going to see bigger firms consider Altruist as a second or third option, whereas as recently as 2 hours ago, they might not have. And that's what's really changed.
And the reason why you picked Morgan Stanley out is because obviously they've made wealth management a key pillar, if not two pillars, of the way that they think about some of the growth engines for their business. I'm curious to how you think, as New Edge, the leader of New Edge Wealth, about this.
Very interested in what happened. We are in kind of the middle layer of this. If you think about the industry, there's custodians and tech-enabled solutions providers. The idea is to be enablers of advisors, elite advisors, as they embark on an entrepreneurial journey of their own. And they're starting to realize that no one firm has a monopoly on great ideas. So when you create a structural advantage by allowing advisors to partner with different custodians to embrace core technologies, you add a layer that basically says we're going to organize that for you very much in the same way that an iPhone organizes all the apps, and allow you that access and supplement that with an intellectual capital overlay in wealth strategy, in investments, and in access. This is a real differentiator. No one is going to say, listen, if I'm getting a mortgage, I only want it from one place. What do you want? The lowest price you can get. And what creates better pricing? Competition. And you need organizations that set up for that. Our organization is built on a middle layer to do just that for advisors that are starting their own firms, and we also have our own advisors. So I think this is the model of the future. I bet my career on it.
Josh, thank you very much. When you're out shopping, look out for Josh in Jericho, New York today. Right? Isn't that the Isn't that to stretch where the
Lambeau Road?
where the
Roslyn, he's
dealerships
probably in
are?
Roslyn, knowing Josh.
I'm on Northern Boulevard. See you tomorrow.
All right. Thank you. That's Josh Brown.
Okay. We're gonna skip on the Trump thing. Okay. So yeah. Basically, the stock is trading at 100, and your strategy dictates you want to short it. You want your stop loss to be at 103. Short the stock at 100, so stop loss, Leave the stock alone, sell the call, buy the 105 call, How the out of the money spread replaces your back. By shifting the short call up to your 3% stop loss line. By shifting the short call up to your 3% stop loss line. Against the trade energy, instructions, even just both options expire worthless. I want the out of the money one. I want the wiggle room one. If the stock spikes to 305 on Tuesday, you get stopped out for a loss, even if the stock only transacts. You get website. With the out of the money spread, because your short strike is at 103, if the stock ticks up midweek, you're not automatically stopped out. As long as the stock drops back below 103, by the time you close the trade, you still make money. That's interesting. The options give the stock room to breathe without clipping your risk return. Stock completely break up against you and surges to 110. Our gaps up overnight. Short is cap, your loss is strictly frozen. There is no free lunch. By moving your short call from 100 to 103, you're making the trade significantly safer and easier to win because it's safer than market pay. And at the money might pay you 80 cents. And out of the money might pay you 25 cents. That's a big deal. You might be risking 175 to make 25 cents. However, because your win rate shoots up dramatically, since the stock has to rally more than 3% against you just for you to start losing money, because your win rate shoots up dramatically, the stock has to rally more than 3% against you. Just because the mathematical expectancy remains highly profitable. Okay. Essentially keep the exact same entry signals. Drop your current bracket. Okay. What about option liquidity? I gave you a list of my recent shorts. Can you tell me the liquidity on those in terms of had I used the bear credit spread strategy? Or can I feed you in some information to help with that? I guess I could show you I don't know how to find historical option prices. That's the problem. Yeah, I don't know how to do that because Thinkorswim doesn't do it. Interactive Brokers might. Based on current institutional exchange rate across your trade, like your shares fall into 3 distinct options liquidity tiers. Tier 1 is institutional liquidity, flawless execution, the big ones. You can get filled. Tier 2, and then tier 3. Do not sell spreads on these. DRI, APH. Yeah, the slippage will chew up over 30% of the premium you collect. Slippage. Those are like the least liquid ones anyway, though. Slippage will eat up 3% of the premium you collect on those. Anyway, the slippage will chew up over 30% of the premium you collect. That's a lot, I feel like. Okay. Pull up a ticker. Anyway, what about liquidity down the road? Let's say I only do tier 1 and tier 2. What are the liquidity constraints with the short strategy versus the bear call spread strategy? Which will start to show liquidity drag first? I'm guessing it will show up in the tier 2, of course. So for example, what are some of the tier 2 ones? Mongo, ZS, and Airbnb. Mongo trades like 500 million a day. ZS trades like, let's say 300 million a day. And I already forgot. Oh yeah, Airbnb trades like 500. So we'll just say conservatively 300 million a day. Example. Conservatively, Mongo, Airbnb, ZS trade $300 million a day. I don't know what the liquidity options are for those, but where will my liquidity problems arise first as my account scales? For example, the 30K account I have now, a 300K account, a 3 million account, a 30 million account, a 300 million account. Let's see. Yeah, the bear crawl credit strategy is going to have a problem. That's the equity markets. Okay. I knew this thing was stupid. But, well, I'm live penciling it out right now. I see problems with liquidity. The exact threshold stud architecture, but not for a while. Yeah. Block execution features. What does that mean? So for the 3 million account, what does block execution fractures mean? Not even a single market maker. Okay. You trade 2,000 contracts of a bear call spread on a 2-2 20 contracts, 2,000 contracts, sure. It's a tiny fraction of order. Knowing that a massive player is desperate to sell calls, the market makers immediately lower their bids. The spread price instantly drops from it. So how does that compare to just shorting stock? Shorting stock is going to have liquidity constraints at some point too, right? Maybe like 10x higher. Shorting stock absolutely hits a liquidity wall too, but the structure okay. Yeah. Structure of the wall. So we send option to the execution wall. When you short, you hit the borrow and locate wall. There's no borrow and locate wall on stocks, even Mongo or ZS or Airbnb. Pretty sure. I think we're just talking about yeah. Yeah, just stick with the stock. Just the spread thing is it's a mess. Not sure why I guess it has the issue of the acquisition issue, but if borrow availability is flawless, the option spread strategy will still choke at a 3 million account size. Your stock sorting strategy can run smoothly before you even have to slow down your entry speeds. Borrow availability is flawless. Yeah, I just don't like the options thing. Yeah. Because you have to change your strategy based on the stock thing should be okay. It's just going to be a really slow road. Really slow road. Yeah. I don't like the options thing. Although I guess I could try it. I could try it for a week, right? Wouldn't kill me to try it for a week. Okay. What does this person do? This person is crazy. Is this even a US account? That'll be step 2. Nope. Weird. Forecasted revenue growth is about 35%. Sorry, guys, I'm not even showing you what I'm looking at. I guess I opened up the window in the wrong. Very scalable business. If we don't know a lot more people, we're just here. Here and there to get 100 million. This year will be 65 million or so. Okay. So, yeah. There are some economic calendar events coming up. Notably Jackson Hole, namely Jackson Hole. But I do wonder about the options thing. You know? And I also wonder if I even have access to that, if I have to apply to that. Maybe just give it a go. Bear credit spreads. Let's see. Yeah. Okay. Where are we at here? How do you do Where do you do trading permissions? As I would show you this, but I'm trying to get in the habit of not broadcasting my broker all over the internet every day. It's a learned skill. Let's see. How do you do this? Where do you see your options? Where do you see? I'm really liking this AI overview thing. I guess you can just click AI mode now. There's a button. Anyway, you end up here. How do you, yeah, okay. How do you see your options level of approval in IBKR? How do you see that? Settings, trading, settings, trading. Where's trading? Oh, I just scrolled down. Trading permissions. Okay. I have level 2. So what that means is I don't know if I can do the bear call spread. Let's see. Can I do the bear call spread? Bear call sounds pretty badass. No. Short call spread. Okay. Level 3. Let's try that. Okay. It's kind of weird because, yeah. What should happen is I should be able to, like the thing about the bear call spread thing is, it only works on when there's not a ton of liquidity. See what I'm saying? So even though it's a more advanced option strategy, technically, I guess, people say, this thing says, it's not actually useful for people who are like super advanced. Which is a problem. Um, Anyway, that's what we got cooking, guys. I'm not really that stoked on it because it sounds like a lot of complexity, but at the same time, like, at least it'll allow me to take a lot more leverage. Different brokers too that you could use to do this. I think Interactive Brokers is probably the one you want. Okay. Yeah. Yeah. But anyway, now the question is, yeah, let's see how that is. That's a good, interesting question. Let's see. I haven't really updated this, have I? So, AMAT on July 9th was good. But maybe not excellent. APH on the 10th was good, but maybe not excellent. Intel on the 11th was good. Ish. Maybe not excellent. VIAV was trash. AMD was worse than trash. ARM is not good. Looks like we're hitting a rough spot here. Oh, this was excellent. ASE. Rambus sucks. Riot. Sucks. Ish. Target on the 23rd. It's not super good. Corning on the 24th. Actually, very good. Flex on the 25th. Firm on the 26th. was okay, maybe. Let's give that a okay. MXL on the 29th. Pretty crazy. Wolf on the 30th. No. UAL on the July 1st. That one rolled over. PSX on the 2nd was insane. PCAR on the 6th. Pretty crazy. Pretty good. Ish. PCG. Not really going anywhere yet. Definitely came down a lot. It's a no. Pang. I don't know. Mara on the 9th. No. STX on the 9th. No. ADP on the 13th. That's a pretty much a no. Coming to earnings. FTNT on the 14th. Apple on the 15th. Didn't go high enough. Starbucks on the 16th. No. Dollar Tree on the 17th. AHR on the 20th. Dell on the 21st. Ford on the 22nd. NBIS on the 23rd. No, that was HPQ on the 24th. That was awesome. Snow on the 27th. That was rough. Toast on the 28th. The problem with the tight stop loss is you have to take a massive size, but the good thing is you get stopped out immediately. I guess we'll leave it at that. there's just so much nuance. That somehow this shorting thing just seems better after all that. Until much later, when you're forced to take positions that are of significant size. Oh boy. Okay. Faster internet. The internet going faster. That's what we're trying to do. Okay. Anyway, that was a heck of a detour, huh? I don't even know what we just did for the last 2 hours. Okay. We could check the internet speed. Okay. Why are all these websites? Why isn't there just why go? Okay. Internet speed is slow. That's what we know. The speed is slow. But we should be able to do some more analysis here. Whatever the heck we were doing. So They're talking about drugs, boats. Oh, Aaron Levy's talking. Box. What do you think, guys? Box? Jeez. Oh yeah, totally not susceptible to that. Totally. A little bit. Yeah. Very funny. Wow. 6 p.m. I think we're going to be gone by then. Okay. That's a lot of money. All right, now we don't need the 1700th detail on the Facebook 7. But what I would be interested in, first of all, we could just maybe get out of some of these positions here. Yeah, the timing is tough. That's tough. The timing. Be great to get out of this. Get some more vids out here. Let's see. Economic D-Day. Foreign policy advisor to Israeli President Netanyahu. Okay. Maybe we'll not worry about Iran for a second. How's that? That's kind of relaxing, isn't it? Let's see. What else is cooking here? What else is cooking? Okay. Let's see. Ooh, quad trading trap. Listen in. And then let's get to some updates. I don't know about this. Okay. Yeah. I think what we want to do here is keep an eye on this. But what's going on here? We got PCE, we got Jackson Hole, and we got NVIDIA. When are NVIDIA earnings? When are NVIDIA earnings? That's what we want to figure out. 5 p.m. So we'll catch a little bit of that. Not a lot. Yeah, we'll catch a little bit of that for sure. What else? What else? Could just see what's cooking in the market. Let's see. Not sure how we got so twisted up over here. There we go. Still a little twisted up, aren't we? This should be good. Yeah. What I'd like to do is have it so you can see the ticker on the screen. Doesn't sound so crazy, does it? Like that. Okay. So the way to do this would be what? What's going on here? I guess I don't need to sell calls. I just need to buy puts, right? This is getting crazy. Bear credit spread. Okay. So, back here. AI overview. Okay. I don't know how memory works. Huh. Hopefully that'll work. Okay, so yeah, we're going here. And then go in here. I think this is what we want to be doing here, is buying puts. And assume if they expire worthless, then that's just like a it's like getting stopped out, pretty much. Right? Okay. Okay, here we go. And this one. Okay. This is my short stock strategy. Imagine if I had bought puts instead of shorting stock, compute profit, loss, etc. That's what we want to do. Because I gave it the tickers, I gave it the risk analysis. Total of 25 trades. Options pricing depends on blah, blah, blah. Yeah. With path dependence and take into account IBK or margin requirement. For this account, I was basically using full margin the whole time. Okay, let's see. Because that's the only, well, I guess because the loss is capped, that's not a challenge too badly. Path dependent. Stocks with 4 strong, percentage drops would have yielded higher. Brutal string of 11. Short stock and full margin broker intervention is high. None. Cap. But it actually do the expected minus losses. One by one. Mention any margin notes as you go along. I told you the account value, it's 30K. I gave you the trades so you can compute quantity of shares. Assume I maxed out. Put contract buys as well. Alright. This should work. Let's see. Phase 1 is the golden streak, okay? Let's do the drawdown. This overnight push to me, it's much closer to maximum. Currently, expected if The counter cap is now critically depleted. Recovery. Oh yeah, it does have the put option PL on there underneath. I just wasn't looking at it. Okay. So this is good. This is good. This is good. This is good. Drawdown. Wow. Okay. I don't understand. Oh. No, I don't want to pay full premium. Definitely not. We do the calculation so that the risk is equivalent to the premium. In other words, on each of these shorts, I was risking 3% of my position. I was taking, say, 2 positions, maybe 3. So I was risking actually more like 1.5 to 1% of my 30K account. That's the premium I want to spend on the options. Now, recalculate given those contract sizes. Okay, let's do that. Yeah, there we go. Stock P&L, option premium, option return, option P&L. Premium. During that. Yeah, let's do a little bit more. Okay. That's what we're trying to do. Short stock strategy. Let's do that. Hmm. think that's really what I want to do. I want to compare that to the short stock strat. Should be able to compare those two. Option account with lowest path depth, 20,000. Your setup. We assumed you entered at the money put options. Stop trading at 100. You bought the 100 strike put. Your short stock should be the next one. At the money put, find the strike exactly where the stock's going to trading this time. Your dollar, your option picks up. Because you bought an at the money put, your contract benefited from powerful option. Stock crash from deeper in the money. At the end of the move, moving dollar for dollar of the capital upfront to buy it. This acceleration was 2 to 3% stock drops. And then the downstairs. Directional strategy structure superior unless you're highly precise. Or the you buy a put, you have to pay the further options have. If the Stock moves down. Does it slowly or during a day when market volatility is dropping? When market volatility. During a day when market volatility is dropping. You can be completely right about the stock dropping 2%, but still lose money on the put contract because the market deflated the options trade. I'm shorting. The theta, if a strategy takes 2 to 4 days of choppy consolidation for the stock finally drop. Short stock does that, then loses value value. When it drops, your option may just break even because the daily thing got followed up. The main benefit if you short stock on full margin, you're already using the broker's leverage. Scale your position size. Stock full margin, actual reference. Money put option high. Here's a variable 23%. How fast? It's 28 to 30% premium gain. Yeah, it does it. Grinding out high win rate, 2 to 3% moves. We substitute a short stock position for a long put contract when you expect an immediate high velocity crash. Yeah. For your everyday typical day for the options. Takes like 5 days for that 3% profit target. Also, what does this mean? Volatility. The market goes down 2% and the stock goes down 2%. You don't make money. Yeah. So maybe in certain scenarios, put and do something about that. I don't know. A 5-day hold. Short stock. When the stock market is wild, yesterday's demand for puts spikes. The insurance companies actually raise the price of all options premium. When the market calms down, stabilizers, or goes into a slow, quiet grind, fear disappears. And for puts tanks, option premiums are artificially deflated. Imagine you bought a put stock on Monday. Monday, the overall stock market is panicking. So volatility is very high. Pay a high price for your put because it's too expensive. Stock slowly drops 2%. For a stock market calms down completely. Volatility plummets because the panic is gone. The market pretty much shaped. Put lose value because the volatility drop was bigger Then this slow 2% move, your contract is now worth 250. You were 100% right on stop direction, but you lost the downside trade. Yeah. You basically want to know things that people aren't knowing. Cost is virtually zero. 5 days of constant overnight time decay chips away your contract value. It's immune. Okay, so let's just say on the August 24th put on P. Let's say I want to pay $500 premium on a put. What would I have in specific scenarios? You would have made a clean 540 profit by risking just 500. You set the strike price lower. If your stock is 100, if your stock is at $100 and you buy $91 put buy for option costs very little. Stocks are falling, your option contract barely gains in value because the market still thinks chance is low. Stock drops hard and stops exactly at $99. Expiration day. Your direct stock position is maximum winner. That unknown projection possesses no value. Expires completely worthless, and you lose 100% of your premium. Buying the strike exactly where the stock's trading now, your contract starts. Options set for times. Okay. Don't understand still. August 24th, this day. This was recent. Okay. And by the way, this is the P trade. Okay. All I'm saying is, if when I shorted P on the 17th, I also bought a 106 put, how much would I have made on the put? That's what we're going to know. Wow. Let's say a standard 30-day contract. No, not a 30-day contract. A 7-day contract. Oh, did that take a while? 17th to 24th. Yeah, it did take a while. I guess a 2-week contract. Wow. Options suck. That's what we're getting here. At the money put option. Still not sure about this at the money put thing. Only when the expected downside move is large, fast enough to outrun. Blah, 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 blah. Yeah, this is the percent thing. At the money. So basically, the at the money put is equivalent to what shorting this scenario? If I'm already shorting P with a 9% stop and a 9% profit target, and I guess I made like $800 on it, then buying at the money put for $800 would be the equivalent of quadruple. Thinking this one has a higher than 50% win rate of going down, which I think all of the shorts I take, but this one in particular, because the amount I think it's going to go down is such a bigger percent than I normally think. Stocks I pick are going to go down. And for all of them, I think a 5-day window is about the window I think they're going to go down. But for this P trade situation, the put is like doubling up my short position, except if it reaches my profit target, I make 3x what I normally make versus 2x if I had doubled up in stock. So it's a slight pitch for these scenarios, I guess. Okay. Already risky linear short stock grace. I didn't know that there was anything, but structurally better on higher percentage magnitude move than just high win rate. Here the exact comparison where they two create up to you made 800. Take a heavier position. You do have chops. You can allocate double up. Allocate enough margin to short a second identical block. Take that 800 euro plus stop. Spend it entirely on a 2-week at the money put contract. If the stock goes up and hits your put option, premium gets crushed. Your absolute max risk is hard cap to 800. The checklist for applying this at the structural edge of the hero, but it only functions if you use it. Shared muscle. Spend more than 5%. Small 2% move. If you need a massive strategy requires it. Premium, sure to stop collapses. What if you think it'll go down 9% in 4 days? Do you buy the 5-day later option or do you buy a 10-day? 10-day. Cheaper, but it forces you into. Yeah. Okay. An option is it takes somewhere to 50 or 60% of the total amount left on the option. All right, that was a lot of stuff to basically end up in the same place I was already at. That one, I'm shorting calls and buying. Okay, where are we at here? CNBC. Go live. Okay. Yeah, so that's what we got going on here. Jackson Hole, Cadet, NVIDIA. And then Iran. No. Sorry about that. We don't need to worry about that. So basically, what up, Vegas? Good? What up? Basically, what we're trying to do here is, yeah, Jackson Hole is important. So if we look at our report here, NVIDIA earnings is important. And we should probably look at some stocks and just see how everything is going here. Don't think... Yeah, what is happening in the markets? What are you looking at? I think we need to do a little bit of research here, but let's start by just actually looking at the market. So, yeah. Here's the dealio. Starting by industry, PBRXOM, some of the stuff came back, uranium came down a little, this came back a little, this chemical's name, rare earth's name came back a little, copper's back a little. Gold names are pulling back a little. Not super bullish on those right now. The CDE does appear to be holding though. And then yeah, steel name may be having a little bit of a moment. Vail coming back. What else? Nothing else that interesting here. Bloom got stuffed a little bit. ADP still in no man's land. Uber really got stuffed. Airbnb got stuffed so far. Bookings back quite a bit. Expedia is holding. Expedia still looks a little precarious. Wow, Chipotle is holding here after a big pull. It's impressive. What else? Dash is continuing so far. Starbucks actually looks pretty bullish. What else? Yum came back quite a bit. Amazon doesn't look great. Melly came back quite a bit, actually. ANF pulling back quite a bit off the highs there. Five has some time until earning. Leave that alone though. Looks pretty strong. Target sort of holding. GIS just drifting. Somehow Mo is holding. PM coming back some. KMB getting stuffed. EL is still holding. KView getting stuffed. Hyperliquid getting stuffed a little bit. And then now we're getting into the softwares, which are mostly not that interesting. For the most part. Yeah. Salesforce earnings are approaching. Dynatrace looks pretty strong. Still needs to build out. Palantir coming right back. Okay. Microsoft looks somewhat interesting. What else? ServiceNow, some strength. Higher low. I don't know how I feel about this one. Path coming off a little bit. What else? ANET. Boom. CN. Light. MSI still moving. Impressive. Dell looks constructive. Earnings are next week. On Tuesday. A little bit of a runway there. Same with HPE. Dell and HPE. Yeah, that's about it. I think Micron's holding in there. Fox A looks to be pretty strong. Okay. So that's pretty much what I see here. I just don't know about those memory names. But HPE and Dell seem to be moving together. Okay. Hmm. So, this guy's still ranting about SpaceX. Can we just watch Kevin talk about SpaceX for a bit?
Stop wasting tokens every session on tool definitions. We just rebuilt the massive MCP server to cut your AI agent's context overhead, allowing you to query.
Okay.
Kevin is much more interested than most people, by the way, in the balance sheet.
All right, he stopped streaming. But yeah, he's doing some charts. And he's talking about Meta. And then about the TAM for intelligence. So who else can we tap here? Jeremy Grantham. Who else can we tap here? We had some consumer staples numbers come out pretty good. So, yeah. Abercrombie and Fitch numbers. Growth. Staples. Staples are good. Staples. Microsoft, rotation away from Meta. Micron memory, continued memory shortage, particular in earnings calls. People keep talking about memory. I mean, particularly HBM, right? Dell's a little bit more of an enigma, but I think it has AI, enterprise AI ties. So, oh, I see why he stopped streaming, because he's coming back for earnings. Well, that probably makes sense. And then Dick's Sporting Goods got crushed. Interesting. Dick's Sporting Goods got crushed. Okay, well, here's what we're gonna do. Yeah, SpaceX is interesting. I'm just going to show you this thing. This is $100 billion SpaceX.
Oh, Contessa, again, I'm not
plan.
a math major, nor was I. I don't play one on TV. But 300 is more than double 138. Yes or no?
Yes.
Thank you.
Well done.
Thank you. You're very welcome. All right, coming up. Is the exodus from OpenAI a concern, or whether or not the stock goes public? Another executive leaving? Wow. We'll give you the headlines coming up.
All right, we can ignore that. But in terms of written news, which we've taken a little bit of hiatus from, I'll admit, we got a little videoed out there for a bit. This is the big dealio. Okay, NVIDIA's earnings. This is the story for Starbucks. Not Starbucks, Microsoft. And I'm not really seeing oil-related companies with a lot of momentum opportunity. And then Bill Gates thing. That's sort of enterprise related for sure. And then what do they got cooking over here? Bonds and memory. See if there's anything here. Chicken. Okay, well, this is a risk, but it doesn't seem to be that big a risk. Okay. Yeah, so that's what we're going to do. I'm going to get cooking here for the next 2 hours. If you guys do have questions or whatever, comments more like, go ahead and get those, drop those in. But I think we got Vegas represented for sure, this email guy, as well as the guy who says he's from Vegas. And then we got Australia. So what are we trying to do here? We're trying to watch some TV. Yeah.
Closer to 200 billion. That was still an enormous.
No, maybe let's not watch TV. Let's take a little break from the TV for a second. Okay. These guys back from commercial break.
Line about self-regulation.
Here we
I
go.
think he said something along the lines of,
okay,
self-regulation of the most dangerous tool ever invented is sort of how he framed it. And that's been something that the industry has been pushing for and saying it could be like FINRA, if you think of the brokerage industry, that in some ways does sort of self-regulate. That has been one of the examples that CEOs out here have pointed to say, we move too quickly. For actual government regulation to work here, we should do this on our own. That is getting a lot of attention. The fact that Bill Gates is saying, actually, that's not a great idea. We should not let these people police themselves, given the danger. I mean, he talks about bioweapons. He talks about things that would be catastrophic and also have been aligned with what CEO of Anthropic has talked about, Dario Amodei. He has gotten a lot of criticism for being what some label a doomer. And some of the industry have said, hey, listen, this is a negative. You got to figure out your messaging and be more balanced. He has taken a lot of heat for that, I would say, and has had to push back on that. He wrote on Twitter for the first time in a very long time defending his stance, saying, I am balanced, but we got to be realistic about the risk here.
It's just so interesting when the people who are responsible for growing
We're
the
definitely
technology
lagging,
that ends
but
up, now they say, threatening humanity are warning against it. So,
okay.
Kate, thanks.
The trust issue.
Appreciate it.
Definitely.
Yeah.
Thanks, Contessa.
All right, well, speaking of Microsoft, by the way, if you look at the top 5, this is our RBI, random but interesting, the top 5 AI adjacent or AI related stocks of the past month, the number 1 performing stock, Contessa, Microsoft. It's up 29.5%. This 1 month, by the way.
Wow.
Oracle up 28.5%. Supermicro, Marvell Technology, and E-Rocket's
Why
power
is it
provider,
so messed
nearly
up?
20%. By the way, Oracle getting an upgrade today. The analysts seeing an opportunity after one of the most sort of extreme dislocations and drawdowns on the stocks. There's your top 5 AI adjacent, AI related, whatever word we're using, stocks in the past month. All that ahead of NVIDIA earnings tonight. All right, meantime, the rhetoric between the United States and China heating up again. Is the summit next month and the economic relationship, is it getting a little more frosty or is it cooling off? We'll talk to Kyle Bass about that and more next.
Australia and those who put out outright bans. So maybe you can talk to that, Alexandra, about how come it's so difficult here in the U.S. to try and make some crackdowns as serious as that?
Well, Australia's crackdown was certainly serious, but it hasn't been foolproof. It was definitely a big step forward, and it was a big deal that Australia went first because now, of course, there's a growing number of countries that are considering, implementing similar types of restrictions. But I think actually thinking about Australia is a really good litmus test here. I think it was Stacey had mentioned a few minutes ago, what are the enforcement mechanisms here? Everything that has been laid out so far as these changes that may be made if the court approves this, the changes all look really good on paper. But there's always a question, especially because so much of this relies on the platforms knowing how old the children who are using the platforms are. There's a lot of questions about how any of this is enforceable, right? So a lot of these restrictions depend on the platforms knowing with certainty that a person is actually under the age of 18. But if, as we saw in Australia and we've seen in the US for so many years, it's very easy for teens to sign up with fake birthdays. Age verification is a problem across the entire industry, not just for Meta. And a lot of these workarounds are sort of obvious for a tech-savvy, digitally native, generation that has come of age with their phones. The question is, what are the enforcement mechanisms and how successful are actually going to be? So I think Australia is an important barometer in that larger discussion.
Bringing it back to the U.S., at least here in the U.S., Alex, is the ball in TikTok's court now?
Well, interestingly, Meta has been calling on TikTok and YouTube to implement these same things, and Meta is holding back a certain amount of payments, and they're also sort of tempering the kinds of restrictions that they're going to put on users until TikTok and YouTube agree to sort of meet them in the direction, where they're headed. Interestingly, Snap has been a defendant in this larger national social media litigation moment. The AGs have called on Snap to sort of follow suit as well. But I think that the companies, Snap, TikTok, and YouTube, that have settled in some of the other litigation, maybe thought that they were out of the hot seat, maybe thought that they would not be in the spotlight quite as much. But now that this is the agreement that Meta has reached with AGs, I think if anything, it leaves Meta, coming out of this looking in some ways you could say like a hero here, where now the other companies are thrust back into the hot seat and ball is sort of in their court to, for everybody to see where they net out on some of these demands that both the AGs and Meta are making of them.
All right, I want to take a look forward. Stacey, I want to go back to you. We have probably about 2 minutes left or so. Where do we go from here? I mean, I know a judge still has to sign off on the agreement, correct? But where do we go from this step? Because you mentioned this is the perfect, stepping off point. Where does it go from here?
Well, I think once the judge signs off on it, hopefully